This habit, right? 24,800, 25,200, and we'll talk about it in the trade setup. But we saw some bit of pullback there yesterday. Very likely could correct today as well. But could be interesting times. Banks outperforming, IT may do well today. Let's wait and watch.
Yeah, in fact, it's for lack of follow-up buying that could be a little bit of a concern for the street. But like we said, it's going to be important technicals the street will track. But a quick check on how implied Nifty is doing this morning. It's looking quiet with a downtick in early minutes of trade, 87 points lower. Now, there's nothing that's gone wrong domestically, but globally, of course, the sentiment looking rather muted in early hours of trade. Well, let's take you through what's happening across most of those global equity markets. First up, Asian markets are a sea of red. The cuts are not significant, but they are weak. So the Hong Kong market, Shanghai, Japan, all trading with cuts. Japan leading the losses with a cut of nearly 2%. Remember, you've got a bunch of central bank meetings today, not significant, but you've got Thailand, Philippines, and Indonesia who will be announcing their rate decisions over the course of the day. Apart from that, all eyes remain on China's central bank, which will unveil its much anticipated measures to prop up the property market in China. Ahead of that, investors and traders avoiding taking any aggressive long bets on those markets. In fact, the Shanghai index, the blue chip index, is down 13% from last Tuesday's peak, but it still remains 20% higher from the day before Beijing announced stimulus measures. Well, Wall Street as well had a quietish day. Dow, the Nasdaq, and the S&P 500 all eased from the record highs on Monday. Earnings was a mixed bag, but before that, tech and semiconductor stocks actually led the losses for U.S. markets. Goldman, Bank of America, and Citigroup reported numbers that beat street expectations. So financials as a pack have actually outperformed analyst expectations with regard to earnings. Pharma, on the other hand, has been a little bit of a disappointment. So those were very sort of underwhelming in terms of reporting, on back of which pharma counters also did quite badly in overnight trade. Morgan Stanley reports earnings later tonight. So, of course, Wall Street will react to it, and we'll only get a reading of that early tomorrow morning. Europe, on the other hand, didn't have a great day either. They've sold off quite sharply, locking in one of their worst days in over 2 weeks. This, of course, ahead of the ECB meet that's lined up on Thursday. So Europe was quiet and weak. That led to Wall Street seeing a negative start. And, of course, Asia is picking up on that this morning and trading lower. Across commodities as well, what you want to keep in mind is actually just before that, the CBOE VIX has held an intraday high of 20.70 on Wall Street. So indicating that the bulls may be feeling a little bit of discomfort. And expectation is that until the earnings season, and of course, volatility will be the name of the game on back of earnings season and the presidential elections lined up. So no significant up moves or directional moves can be expected on Wall Street, at least. In commodities, crude had it quite rough in overnight trade. You know, it was only a few weeks ago that we were talking about levels of 90 and 95 on crude, but a big dip coming in on crude in overnight trade, down 4.6% on some reports indicating that the US has said that Israel will avoid attacking Iran's oil base. Israel, of course, has retaliated to that and said they haven't confirmed any of that just yet. So stabilizing on crude this morning, but this comes in after a big fall that was seen in overnight trade. Apart from that, bonds and gold trade rather unchanged. All eyes on the rate cut that will be coming from the Fed. So no change in that, and that leads to bonds and gold pretty much trading flattish in early trade this morning. So that's what we have, Niraj. It's a quiet morning. There's no major trigger why global equity markets are selling off. But I think all eyes will remain if China once again disappoints. But I guess we're still hopeful that they come out with an aggressive stimulus later on Thursday.
Yeah, well, let's wait and watch or sometime in the next fortnight, whatever they do. But the other interesting piece, and before we talk about the Indian market, Samina, has to be crude, right? With the kind of yo-yo that it has done yesterday and overnight. I mean, it's quite, the last 12 hours have been like 12 months, if you will.
I mean, crude, Niraj, is behaving like a stock. It just surprises me of how we talk about 20-30% moves in either direction. So very tough to call it out, but I believe we've got Peter Maguire who's joining us with his view on commodities.
Yeah, well, let's get Peter in on the show. Peter, good morning or good afternoon to you already. Thanks for joining in. A bit of a yo-yo there for crude. 4% fall overnight and then a bit of a recovery, but it still hangs in balance there. What's the sense? It just seems, Peter, that despite geopolitical stress, upsides in crude are being sold into because of demand woes?
Absolutely. Good morning, Niraj. I mean, it's very exciting. If you're putting it on a volatility chart over the last 30 days, if 1 is the lowest in volatility and 10 is the highest, WTI is sitting at 9. It's been extraordinary over a 3-week window, 67 up to 77 and back to 70. We've had $17 worth of moves, as Samina mentioned, in 3 weeks, which is just extraordinary. Great for traders, hedge funds, and of course, anyone, that's playing the market or trading the market. So I feel as though there's probably further downdraft. That geopolitical tension as the war premium has been stripped out, but you can't, I suppose, discount the fact that Israel could in turn act in some capacity against Iranian fields. No one knows what their strategy is. So that's always an unknown at the moment, Niraj.
Okay. Peter, so the question really is, if you were tactically looking at crude, would you believe that if Israel's actions are not targeting Iran's crude facilities, there is a higher probability of crude prices staying subdued at circa 70 or below versus they moving higher? Would that be a fair assessment?
Well, yes, it would be. I mean, you've also got to take in consideration over the last couple of weeks that US dollar to the move to the upside has been very, very strong. The index sitting at 103.2, 103.3. So, yes, I think there's further downdraft. And if there's no war premium or geopolitical concerns, Niraj, then yes, 67 could be where you could see a little bit of a resistance. But at the moment, or support, you should say. And we've just got to see whether that, the numbers, as you say on the screen there, IEA revising forecast moving forward. So, it could be a very interesting Q4 to trade the energy complex. You've just got to see where we see support and what the other points of view come into play.
Well, hi, Peter. Good morning. Thanks for joining in. OPEC has indicated, or rather revised their demand outlook downward. Do you anticipate that in the next couple of weeks, we could expect OPEC Plus to play a role in stabilizing the disrupting sort of supply chain and, of course, slowing demand? Because $67 a barrel doesn't keep any of the suppliers happy.
No, Samina, no, it certainly doesn't. Good to see you. I think that's the issue at hand. You've got a meeting towards the end of November, traditionally with OPEC and OPEC Plus. So we've just got to see where that runs over the next 6 weeks. Their focus naturally is on higher prices. That can't be disputed. There's plenty of oil out there, but you've got waning demand, as we've noticed, a revision down as far as global demand, and of course, what's happening, in the short term with China. Also, the opaqueness of their policy and what they're prepared to do from the property sector. So all of these factors need to be considered. And at the moment, it's a fantastic market to trade from a volatility standpoint. But where price swings to, well, that's always the unknown. It's a wild market.
Indeed, wild. And if it's $67, $70 a barrel, with an impending rate cut in the US, with geopolitical risk still very heightened, demand in India not too bad, maybe some stimulus coming in from China, would you recommend going long on crude at the current market price for the next 4 to 6 weeks?
Well,
or till the end of the year?
Well, yeah, I got to say yes, but if I look at over the last 3 weeks, Samina, you've seen a $17 move, both from 67 to 77 back to 70. I wouldn't be surprised it goes back to 80 if you've got some, uneasiness geopolitically. And I feel as though possibly 67, 65. So I think it's going to be bullish in the short term because of these unknown factors that can play into the market at any time. You've also got the election coming up in the States and the US dollar strengthening. So if that comes under a bit of pressure and sell off as far as US dollar with a hefty rate cut, then that could change the dynamics of the WTI and Brent as well.
Right. Peter, very lastly, you also track commodities beyond crude. What is the outlook? Early this week, commodities on the LME were trading much higher. Tuesday, they took a bit of a break. This morning, I'm not sure what the reading looks like. But if you had to have 2 calls, bullish and bearish, what commodity would you pick for each universe?
Well, I like copper, Samina, it's running at around about 95.30. It's well off its $10,000 that we saw recently. It's sold off on the LME 1.35% in the last session. So I feel as though that's probably being downdrafted alongside crude. So I think it's going to be volatile. Keep an eye on copper. That's one thing that I really like from a base metal, but my focus probably more so is on the yellow metal, and I think silver and gold are going to be extremely hot over this quarter.
Thank you, Peter. It's always such a pleasure talking to you. Great to get your perspective, not just on crude, but other base metals as well. Of course, we'd love to chat with you about gold too, but maybe next week before the run-up to festive season back home. Well, it was an interesting day of trade yesterday. Remember, we had a strong handover from Asian markets. Wall Street also, remember, had a good run on an overnight trade on Monday. But the euphoria, remember, didn't last for too long on Day Street. We started off positive, but finally gave up gains in the second half of the session. The Nifty, of course, lost some of its euphoria and momentum as we, of course, closed shop in trade yesterday. A quick check of how trade played out and what led to that weakness. But what we've seen over last week as well has been after a day of gains, the day following that has seen a lack of follow-up buying, which has led to weakness in terms of trading activity. The Nifty did close about 25,000, so we respected that level. But as we've indicated to you, 25,200 is an important sort of resistance from which we've been turning around over the last couple of days of trade. So any attempt to go beyond 25,200 is getting sold into. Bank Nifty, on the other hand, did well. It was the second consecutive day of gains yesterday. Remember, you had gains on likes of HDFC Bank on Monday. Yesterday, it was the turn of ICICI Bank that supported the Nifty bank. 51,900 is a good level for Bank Nifty as well. PSU banks haven't participated too aggressively. Remember, traders have been awaiting SBI to make that move, but that counter has been largely an underperformer in the first few days of trade this week. Well, apart from that, your RIL that disappointed the street with its earnings. Even though brokerages are constructive on the counter, the street wasn't too pleased, and that led to the stock selling off over 2% in trade, potentially one of the key contributors in the sell-off on the index as well. Auto stocks saw some weakness. You had the big Hyundai IPO that opened for subscription yesterday. While the excitement ahead of that was pretty euphoric, subscription numbers on day one don't seem too impressive, coming in at 18% only. So while, of course, the absolute number would be significant, in percentage terms, we've seen better subscription numbers on day one in the recent subscriptions that have opened on the street. HDFC Life, HDFC AMC and Newgen Software reported earnings. HDFC Life numbers weren't too great. The stock was down 3.5%, but Niraj tells me this morning that the brokerage reports, brokerages like Citi seem constructive, so that stock could be one to track and trade. Apart from that, Newgen Software as well, good set of earnings. A lot more euphoria and a lot more buying could continue into today's day of trade on back of their con call too. So the stock was down 4% yesterday, but a recovery today on back of anticipation of a better outlook cannot be ruled out. So all in all, not a great day, and it may not be too good today as well. So selling may continue, and a close or an opening sub 52,000 is what we're anticipating. Just before I hand it over to Niraj for trade setup, a quick check on the WIX, and let's see what's going on there. Because remember, the WIX globally has been elevated. Back home, it has actually ended flat. So no concerns, at least on the WIX this morning.
Yeah, touch wood. Never mind what's happening.
I like how you touch wood on that.
Yeah, I mean, rather want stability.
We don't want to go into the festive season feeling down and out, right?
That too. And definitely not volatility, because portfolios, they don't make money, for sure. I mean, but yeah, the interesting piece was, Samina, that the markets obeyed the template. And the template was that selling at the upper end of the 25,200 to 24,800 range. There we're seeing selling, we see buying at this 24,800 kind of a range. So that kind of piece has continued. Smart money is now talking about continued outperformance in the Bank Nifty vis-a-vis the Nifty. So actually people are talking of pair trading Bank Nifty versus the Nifty as well. I was trying to look at the 1 month performance, and really not too much of a deviation, but maybe a slight bit of outperformance from the banking space, which is the orange line, versus the Nifty, but nothing dramatic thus far. The question is, can that change? That is one.
And talk to me about Bank Nifty, right? Because we've seen HDFC do okay on Monday. You called that trade. ICICI Bank gave the support yesterday. Is there a chance that SBI may see a breakout? Because, all through Monday and Tuesday, there were very aggressive technical calls going on SBI.
And
the PSU basket doesn't seem to participate. I have no idea why, but I don't know if you've heard anything or you've picked up anything in terms of trade.
No, not really.
So it's not going to be the stock of the day?
I have no idea. I think the stock of the day could well be BSC, and we'll talk about it.
That's true, actually.
But I was just talking to some people yesterday who said that their study seems to indicate that banks might see a period of outperformance. There are 2 or 3 banking funds which have been launched as well.
Yeah,
which might
the NFOs don't seem to stop.
And which might be forced to put into banking money, right? All the capital that they're raising. Which is why I was talking to somebody about how, for example, the Cummins numbers look wobbly. And I was told that I think Kotak has an MNC fund which is shutting on the 21st.
Yes, of course.
And therefore, you ought to be careful about shorting MNC companies because that fund will deploy all of the proceeds.
All their money. In fact, talking about that Kotak MNC fund, I was talking to Harsha, and I think the one question I asked him is, what would you do with Hyundai? Because that becomes the biggest MNC you would want to go out and subscribe to, right?
Too, yeah.
But we didn't see that in the anchor book, so there was no buying that came in from Kotak on that note. But you said people are talking about buying into banking. Any biases? Is it private sector, PSU?
No, just heard that. And private sector, yes.
Oh,
private sector,
private
large
sector.
banks.
So the bias still remains on the private financials in many ways.
Yeah. And lastly, I'm sure Rucha at some point of time will talk about this on the show as well. But the ISG data yesterday seemed very promising. It was a bit of a surprise to see this, but ISG reported a very robust Q3 CY24 deal flow data. Managed services deal flow was the highest ever. X as a service continued its acceleration, 23%, and the total deal flow number grew in double digits, 15.1% YOY. So the ISG data is looking very strong. So while tech globally is disappointed, but ISG data could well have the stocks today. So while IT was somber yesterday, Samina, it'll be interesting to see if IT gets a bit of a leg up today. So certainly watching out for that. On a very mild results day, there's nothing else in terms of results, really, 1 or 2 names. It's all about individual pockets.
And I think IT may even get that leg up because it's been rotational, right, Niraj? All through September, IT was such an outperformer. Then early October, we didn't see too much of a sell-off, but the area or the space was not doing too well. You saw earnings from HCL Tech, to add to what Niraj said, which were actually very good. The strong commentary, the earnings management said that they were actually impressed with how well they've done. But the stock itself didn't eke out very sharp gains. Now, one reason to justify it is that on Friday, the counter had hit a life high. So maybe what it's doing is spending some time consolidating in that range. You also have Wipro, which we've talked about. It's been an outlier of sorts in the last 4 to 6 weeks. We do understand that when they report earnings, they've got a board meeting, a bonus issue is expected. And remember, from all its Nifty and out of Nifty peers, this is one company that has done the maximum number of bonus issues historically. What you also want to remember is the last bonus issue that came from Wipro was all the way back in 2019. So a big bumper Diwali gift to investors of Wipro cannot be ruled out at this stage. So there's enough and more happening in the IT pack. Watch out for that. Pharma is one that I want to talk to you about, Niraj. It's been on the sell side, and we saw earnings on Wall Street from US pharma companies that are rather underwhelming. Do you feel like that sentiment could pass through into India, or it's too far-fetched?
I would love to know what you feel about it as well, Samina. But just the very limited point out there before we move to stocks on pharma, at least for today's session, it does seem that there is some positivity on select exporters because the volume data that has come in, the export data that has come in, has been very constructive for some companies at least. So Divi's, the Entresto growth continued, added Roche as new client, and therefore Divi's clocking in some very strong export data growth. Newland Labs, Piramal, and Dr. Reddy's. So 3 or 4 names were very interesting, especially Newland and Divi's. So I think could be very interesting to see what those two do in the session today.
At least a handful. But it's had a good run, right? All through last month or so, pharma has been on the buy side for a lot of people. And for good enough reason, the outlook was looking positive. It was a sector that was under-owned. And, of course, the sectoral rotation only helping this pack. But track pharma, 2 pulls and pressures on one. Of course, like Niraj said, it's looking good. But on the other hand, the earnings reporting of pharma companies that came in from Wall Street was rather underwhelming. So So there may be an upside that could potentially be capped on some of these names, but we'll wait and track it. But watch out for banks and IT, like we've highlighted for you. Now let's quickly move down to stocks. No major earnings are expected today. We do have a handful of counters that have reported, and the markets will react to that. I'll highlight KEI Industries. Numbers were very average. In fact, net profit was up 10.3%. Revenues were up 17%. So the stock did go up 2.5% just before the earnings in yesterday's day of trade. It could be buy the news, sell the rumor, or rather buy the rumor, sell the news on this one. But track it. Earnings, like I said, rather decent to say the least. EBITDA was up 9.1%. Margins, though, have narrowed. So while the top line looks pretty healthy, on the margin front, they've seen some pressure with margins contracting 70 basis points. And the other big news on KEI is fundraising plans, and that's pretty much been the theme all through 2024. You know, even outside earnings, every other day we have companies announcing their very aggressive QIP funds and, of course, expansion plans. So 2,000 crores is what they're looking to raise through a QIP. So KEI should be on your radar on back of that. Apart from that, you know, we've talked about how order wins are picking up, and a whole bunch of orders are coming in from the Maharashtra state. So you want to track two companies that will react well to order wins. PNC Infratech has got a big order, 4,630 crores coming in for two projects from the Maharashtra State Road Development Corporation. Along with PNC Infratech, GR Infra Projects has also won an order to the tune of 1,885 from the same, which is the Maharashtra State Road Development Corporation. A third I want to add to this list is Cochin Shipyard. Now, this one is a very active stock in the first half of this year, and then they sort of fell off the ledge recently, of course, with PSUs going out of flavor with traders and investors. But what we understand is the government is looking to divest 5% stake through an OFS, the floor price of which is set at 1,540, which is an 8% discount to yesterday's closing price. The OFS also includes a base offer of 2.5% and a green shoe option of 2.5%, which the government may or may not choose to exercise depending on the demand for their supply. And that's, of course, Cochin Shipyard. And watch out for crude sensitives. They've been active last 2 days. May see some more buying in the likes of an HPCL, PPCL, a Berger Paints, Asian Paints. So tire companies, paint companies, OMCs back on the radar this morning, Niraj.
Yeah, some very interesting names from that list for sure. It just, you know, Samina highlighted PNC and GR Infra. Yeah. Ashoka Buildcon also received an LOA for a construction project worth 1,127 crores.
They've been on a roll. They had a big one of 400 odd on Monday, I think.
Yeah, and PNC Infra too on a roll for so many months, right? So so
and
many
this is again
days.
Maharashtra State Road
Maharashtra State, yeah, MSRDC. So Ashoka Buildcon, no, it's I don't know if it's for a Maharashtra. I think it's a Maharashtra State project, but not quite sure if it's for a road or another thing. But Ashoka Buildcon has received an LOA.
The Maharashtra government coming to the rescue of these companies.
Yeah, for now, certainly giving orders left, right, center. Rallis, the only reason I mention this once again is because after a long time, we've seen Rallis deliver on a quarter. So revenues up 11.5% at 928 crores versus 832. Margins at 17.9% versus 16%. Big beat on margins. And net profit up 20% at about 98 crores versus 82 crores after a really long time. We've seen Rallis give a good quarter, so do watch out for that one. And Mastech, we spoke about yesterday that we were hearing that some smart money bought into Mastech, and therefore now the data is out, but I still think that while the name that has come out is Alidra Textool Engineers, a lot of other smart people have bought into the block yesterday. Watch out for further rallies here. I'll watch out for Newgen Software as well. The stock got clobbered in trade yesterday, but the Jefferies note is very constructive on Newgen, so do watch out for this one. But just lastly, before we get to Sajid, brokerage note, Samina, I think might move stocks materially today. The Jefferies note on BSC, we talk about it in detail, but they are saying that the risk reward turns unfavorable, and they're
unfavorable.
Yeah, they're saying that downgrade the stock to underperform, and while the target price has been raised to 3,500. It's way lower than the 4,800 target price. The key line is that they are saying that the valuation at a PE of 40 times FY26 implies BSC's market share rising from 13% to 30%, which fails to capture the risks of execution on BSC's part. So that is one on my list at least. And the last one is the City note on HDFC Life. You were talking about it, right?
The earnings one, and the stock did sell off yesterday.
Stock sold off yesterday, and which is why this becomes important, because they are raising the target price to 820. You will hear from the management at 9:30, by the way, HDFC Life management, but their note says that management expects, while one-offs marked the Q2 margins, the management expects 2H margins to be higher than the 1H. They retain the VNB growth guidance, and therefore City is raising the VNB multiple to 20 times from 18 times, and therefore they have raised the target price to 820 from 735. So watch out for this one today.
You know, you talked about BSE valuations. I don't know since when that's become a concern, right? I mean, I look at a PFC, REC, or Trent, but again, having said that, we were talking about how the Maharashtra state is giving out orders lock, stock and barrel. There's one more small order that's gone to RailTel for the rail part of the Maharashtra State Development Authority. It's not a huge project, but I think it might have a sentimental impact on the counter. It's to the tune of about 80 odd crores that they've managed to bag. So the state coming to the rescue of a whole bunch of these companies. Another quick one that I want to highlight is that you have an important earning as well from the Nifty 50. It's Bajaj Auto that will be reporting numbers, along with the likes of a South Indian Bank, CRISIL. Those are the slightly medium-sized companies that report. And of course, beyond that, you've got a whole bunch of, an emphasis. Beyond that, you've got a whole bunch of smaller companies reporting numbers. What I also want to quickly highlight is the Vari Energy's IPO. There's been some excitement around this, but what we hear this morning is that Vari has set a price band of 1427 to 1503, which is the price band that is set for its IPO. This comes in at a huge discount of 45% to its unlisted price. In the unlisted market, the last trade on Vari took place in the range of 2700 to 2750. So, of course, a price band of 1427 to 1503 is at a deep discount to what it's currently trading at. What I also want to quickly mention is that the grey market premium, though, is still at an 85% premium. So closer to the level of 2800 is what we have. So yeah, keep that in mind if you're looking at this subscription over the course of time. It is coming in at a deep discount to what it's trading in the unlisted market. So we've got enough and more for you to trade this morning. Lots of activity on stocks. We'll, of course, only extend that list with a technical guest who will join us shortly. But, of course, the big story this morning is Adani Green Energy has decided to defer its $1.2 billion 20-year note in the U.S. bond market. The deal would now be executed after the U.S. elections and is expected to be lapped up by investors on account of its attractive credit highlights. My colleague Sajid has more details on this. Sajid, over to you.
Adani Green has decided to defer its $1.2 billion 20-year dollar bond issue. The decision to defer the issue comes at a time when there is volatility in the U.S. markets ahead of the U.S. elections. The company has decided to defer it to after the U.S. elections, as it would get a tighter rate, and also favorable conditions which will come in because the volatility due to elections would be over by then. The entire hybrid issue comprised of 1,840 megawatts of solar and wind assets, and it was used to repay and refinance some of the existing debt. Now Adani Green will look to come out with the issue either in the second week of November after the elections, or the second window which opens up after New Year, which is second week of January.
Okay. Thanks for that, Sajid. So deferment and not a cancellation. That's the event that has happened. It'll be interesting to see if Adani Green takes a hit today or no. But clearly, as Sajid has laid out, that it's a deferment of the issue, a dollar bond issue, and not really taking it off the market. Standard disclosures: the Adani Group owns NDTV, and you're watching NDTV Profit. So that is one big news. The other big news is IT, and the updates are interesting because the recent report from the ISG from International Services Group highlighted a record-breaking quarter for managed services, driven by an increase in mega deals and lower contract durations. Confused about this? Let's go across to Rucha then to try and simplify what is the importance of this data release. Rucha, why is this important, and what does the release from ISG say?
Right, so ISG reported its third quarter results. Now, ISG is a group which tracks IT on a global basis and tells us about how the global markets are doing with respect to technology. Now, it reported its managed services number at its highest level, highest ever deal flow is what has happened on the managed services side. And talking about the total deal inflow, this was also the highest ever. But what is relevant for Indian IT companies is the managed services deal. Remember, Niraj, even if we track, even when we track Accenture, we look at the managed services deal wins, because that is what is relevant for the Indian IT companies. And this coming in at record high means that this is very much positive for the Indian IT companies. Now, talking about the BFSI sector in particular, because majority of the IT companies receive most of its revenue from the BFSI, that is the banking space. Well, this space has been challenging since last couple of quarters, and this time also ISG has reported muted or even negative, like negative 1% year-on-year growth in this segment. But in the commentary, the management mentioned that BFSI still remains a challenge. However, it is expected to improve because of the rate cuts in the US. So this BFSI sector is likely going to be a little bit of pain for the IT company, but overall healthy deal inflow is what we can see is a big positive. Overall, the results from ISG is very much incrementally positive for the Indian IT companies, but we'll see what Infosys has to say on this, because Infosys is set to report its result on the 17th. It is also expected to increase its guidance, so more update from the management is what is to be watched out over there.
Rucha, just one thing. Yesterday you had mentioned about Newgen Software. The stock had taken a hit, and you had mentioned that there's a con call. Any chance you got a chance to look at what the con call takeaways were?
Right. So the management held its call at 4 o'clock yesterday, and management reiterated its guidance of achieving a CAGR of around 20% and achieve $500 million in revenue over the next 3 to 4 years, and 50% of this growth outlook will be, fulfilled from upsell solution, is what the management mentioned. It also mentioned, foraying its presence in the insurance and government verticals, and achieving 40% of revenue share from these segments versus current level of 22%, again over the next 3 to 4 years. So strong numbers is also followed by strong commentary in Newgen Software.
Right, thank you for that, Richard. It's going to be an action-packed morning for tech. At least that's what we can hope, on back of a little bit of positive commentary coming in. But along with that, there'll be a whole bunch of other stocks you want to track. Remember, the implied Nifty is indicating to a quiet start. A start's up 25,000 is what we're expecting. But before that, of course, is in the benchmark. There will still be pockets of interest, and that's up on the list. Remember, GR Infra and PNC Infra both have managed to win 2 significant orders from the Maharashtra State Road Development. Ashoka Bilcon and Seagull have also bagged significant orders, so those 4 counters should be on your buy list this morning. Along with that, you've got Sansera Engineering. They've announced a fundraise plan through a QIP for 1,200 crore rupees. And Newgen, while the numbers came in before markets closed yesterday, the stock reacted negatively. The commentary that came in from the management is very promising and convincing, which could see the stock seeing some bit of positive reaction.
Yep. So these are 4. The other 3 are Rallis, and I wonder if Rallis numbers actually augur very well for the sector at large, because their margins have come in strong and there's a 20% PAT growth. So watch out for Rallis in the session today. Something tells me this could well turn out to be the one key mid-cap stock today. Godrej Properties is the highest bidder for 3 MMR plots. Let's see if it drops off on the stock. HDFC AMC CLSA has upgraded the stock to an outperform rating.
Well, you also got a few stocks that are going to be on the sell side for specific news reasons. Cochin Shipyard, the government is looking to divest up to 5% stake at a pretty significant discount to yesterday's close through an offer for sale. BSC gets a big downgrade from Jefferies. The stock could be under pressure on back of that. Well, KEI numbers were a mixed bag. They've announced a fundraise plan too. Margins have shrunk, but the top line didn't look too badly, but could be a stock which may see selling in trade today. Well, those are the whole bunch of counters you want to track. We'll take a break. We'll come back. We'll put the focus on the F&O action, so stay tuned.
Welcome back. This is India Market Open. We are taking stock of the futures and options space. It's turning out to be an interesting one, but it's also been range bound as far as the Nifty is concerned. Let's start by taking a look at how things shaped up yesterday. It was a day of trade where we saw continued consolidation, with the benchmarks, of course, moved largely sideways with marginal moves. The Nifty ended lower by around 0.25%, a little over that. Very little change in open interest. The Bank Nifty more or less the same, very little change in the spot and very little change in the open interest for the futures. But as we move in, through this week, in terms of the options market, what we're now seeing is a little bit more base building around the 25,000 put. And on the higher end, from 25,000 25,500, pardon me, the activity now shifts to 25,200 lower. So it does seem like the range is once again converging, consolidation coming through. That is the indication based on the writing that we're seeing with respect to calls and puts. But of course, today is also the Bank Nifty weekly options expiry, and what we are keeping an eye on is a 500-point range between 51,500 and 52,000 on the higher end. Moving on, let's also talk about stocks. It was a mixed day of trade, but more gainers and losers. Deepak Nitrite stands out. We'll talk about Deepak Nitrite in just a bit. PVR, Inox, HPCL and Page Industries as well, looking at fresh longs. And among stocks which are unwinding, again, we are looking at about a short covering for HCL Technologies, Apollo Tyres and L&T Finance, and Divi's Laboratories and Tata Chemicals. On the other hand, looking at, long unwinding. But with that, let's get in Avni Pathak of GN Financial to tell us about what she is spotting in these markets. Avni, good morning and thanks so much for joining in. Avni, Deepak Nitrite specifically in this case has been a very interesting one, but we are looking at a positive traction for now. I believe that's also on your radar. Can you tell us what you're making of it and what kind of option structure you're deploying here?
Good morning, Agam, and a very good morning to all the viewers as well. So yes, after a decent correction of nearly almost 10 to 11% in last 2 months, the stock saw some consolidation, forming a base around 2750. And in last couple of days, a higher high, higher low formation has been seen in last 4 or 5 days. And as on yesterday, the stock managed to close above its short-term exponential moving averages of 20 days and 50 days on the daily charts. And there was a massive single day long addition of nearly 14% in October futures. Also a rise of around 54% in volumes, in future trading volumes. So that's a pretty huge buying that is coming in the stock. And OIPCR for the stock has improved from 0.49 to 0.69 as on yesterday, which shows that there is buying momentum that can push the stock higher in coming days. So put writers are getting back in the system since the OIPCR is improving. That will act as a catalyst in the further up move for the stock. And we are expecting a good momentum very soon. That's why we will go with a vanilla call option of 2940. That is an ATM call option, closed at around 63-64 range yesterday. We can target a profit of 110 rupees on the premium, and stop loss can be kept at 52 rupees. So in monetary terms, that would turn out to be a profit of around 13,800 on per lot, and the risk would be limited to rupees 6,600. And
so as you can see on your screen there, this is of course what Avni has mentioned, and the risk reward certainly favorable, and for the many reasons that Avni thinks that Deepak Nitrite could in fact go higher from current levels. But Avni, the other one on your radar is Godrej Consumer Products. Can you tell us about this one as well?
Yes, so again, even this stock has seen a 4% long addition in futures, a positive RSI crossover at the lows, which is around 30%. So RSI is anyways oversold, and we have seen a positive crossover in the oversold zones, which is a very positive sign, a perfect candidate for reversal. So even for this, we are expecting a good momentum very soon. That's why we'll go for a vanilla call option in Godrej Consumers also. We buy October 1340 call at a premium of 26 to 28. And the target on the premium would be 54, and a stop loss will be 15 rupees. So again, in monetary terms, it's almost 1:2 risk reward ratio. 13,000 would be the profit, and risk would be around 7,500.
Right. Avni, just a follow-up, you've chosen vanilla call options to buy, and we are not too far away from expiration, which means that the reason why you're choosing vanilla call options and you're not choosing spreads is because you also expect these stocks to move up higher very quickly. Am I correct?
Absolutely, Agam. So the momentum is going to be very quick, probably in next 1 or 2 days, and we'll see a good momentum pickup even today.
All right, there you have it. Well, Avni, on that note, thanking you for joining us and, giving us your views on those two stocks and how we could potentially go about using options in terms of markets. We will be watching out for that. So thanks so much. But for all of you who have queries with respect to futures and options, potentially on a position that you already hold or an interesting idea that you are seeking to place bets on, don't forget to write your queries on the WhatsApp number which is flashing for you on your screen, and we will be sure to take up your queries on the F&O show at 10:30 today. And with that, it's back to you all.
Thank you, Agam, for that. Yes, please write in. We'd love to hear from you. This is an interactive show at 10:30, so the more you write in, the more we are able to respond to your queries from our experts. One sector that's been in the focus and was on the sell side yesterday was the auto pack. Remember, we've been talking about auto extensively over the last couple of weeks. Now, there was a report put out by Morgan Stanley which has indicated that the growth of auto volumes has clearly shown signs of moderation in the second quarter of FY25. According to them, the auto team maintains a conservative growth estimate in the low single digits for the fiscal year. And I think, Agam, Niraj, that's why the 32 days of the festive season that kicked off on 3rd October becomes even more critical and significant for the sector, right?
Yeah, I mean, it was interesting to see. Somebody was talking about, one of the dealers was saying that the first 9 days we've kind of done nearly equal to the September volumes. Not a benchmark really. September was a very ho-hum month. But it'll be interesting to see if indeed the commentary for the companies when they come out of the results talks about a slightly better performance. So
I don't know how we view this because Niraj, we did ask him as well, and he said a lot of the sales have come in on very, very strong discounts. Now, is that usual?
I mean, no.
Is that a good thing? I don't know how to view this anymore.
No, Samina, from a period, I mean, there's a big high and low because from a period of waiting for deliveries for like 6 months to now ready delivery in most cars coming at a discount, I think the sector has gotten quite a sea change, if you will.
In fact, even vehicle financing companies, they've also been under a little bit of pressure, right? The second quarter was very sluggish, or is expected to be sluggish in terms of including recoveries as well as compared to what we saw in the first quarter. But you have the big daddy, Bajaj Auto, that reports numbers today, so we'll talk about that in a minute. But Kush Bora joins in with his technical view in the market. Kush, we've already taken our viewers through everything that they need to watch out for fundamentally. But before we go into your stock picks, how do you feel about the Nifty? It seems like a starts up 25,000 is what we're eyeing.
We could perhaps rewind, this conversation back about a week or so and still replay, and the view might still be the same because that's what Nifty's been doing. I think Niraj has also mentioned this a couple of times already, which is 24,700, 24,800 on the downside, 25,200 on the upside. What's heartening to see is that Nifty is respecting those levels, for the moment. And just to...
So you're not disappointed that we touched 25,200 and the selling comes in and then it sort of again eases off?
No, in fact, I'm quite encouraged and enthused by that fact. One, because those are the levels that we've been talking about, and they have been respected.
25,234, I think, was a high that the Nifty made last Wednesday.
And you take that because we've had, prior to this and in the last week, we've had 2 weeks of very high volatility. So a bit of consolidation is not a bad thing. We might perhaps be setting up for a Diwali rally is what it's looking like at the moment.
I like the glass half empty.
Always.
But also what I think is not doing too badly is a little bit of hope that Bank Nifty is giving traders. The last 2 days was good. 51,900 is where we shut yesterday at. Now today is going to be a tough morning because the global setup is not going to be very supportive, right? Do you feel like Bank Nifty may continue an up move? And even if it doesn't, if it gets a small gap down, does that become a good long trade on Bank Nifty?
It does, but just to complete that conversation on Nifty, I remember a very beautiful line by J.R.R. Tolkien, which is that, not all who wander are lost, right? Nifty is wandering right now, not giving a very clear directional play, but that is okay because, as I said, we've had a couple of weeks of very high volatility up and down both. Now we're consolidating. As long as Nifty does that and remains in this zone, you'll have a lot of stocks taking heart from this and perhaps moving, and we're seeing that kind of action in the broader markets, right? So not too discouraged by this as long as 24,700, 24,800 on the downside is respected. Now, to come back to your question on Bank Nifty, yes, we were more positive on the Bank Nifty for the last couple of days at least, if not more. 51,500 was the level that we were looking at. That's been taken out. Now, as you rightly point out, I think perhaps a bit of a caution is warranted, and on a pullback, a buy makes sense. Two reasons for that. One, on the weekly expiry, if you see today, the 52,000 call has massive writing. So there could be a possibility that that level might be respected for the day. Also, very interesting is that yesterday the Bank Nifty was up, opposed to what Nifty did. But that was on the back of very bad market breadth, which is only 2 stocks out of the 12 were actually in the green and the other 10 were in the red. So while a couple of those stocks being, I think, Federal Bank and ICICI pulled their weight, and the others as well, it's not a good sign from a near-term perspective. So yes, you're right, on a pullback closer to 51,500 levels, with a stop loss of 51,200, you could consider going long on the Nifty. But from the near-term perspective, and by that I mean today and tomorrow, 52,000, 52,200 might perhaps be the target that you want to play for.
Okay, and with those targets in mind, what are the stocks that you're recommending today?
A couple of them, neither from the financial services or the Bank Nifty space. Siemens has made a very strong comeback, and a couple of stocks. Siemens.
I was about to say cement. I'm like, what happened? No.
But Siemens, you're saying, has made a strong comeback.
Siemens has made a very strong comeback. If you see, the key averages were taken out some time ago. But yesterday also the stock was up on very decent volumes. I think the stock is now perhaps going to hit new highs very soon. So from a near-term perspective, you're looking at 8,000, 81.50 as the near-term targets, 77.50 being your stop loss.
Krish, one follow-up. You'd buy an FNO position here or a cash position here?
I wouldn't mind an FNO position as well on this one. That's the kind of move and the confidence that it's giving.
Okay.
The only caveat with that is that you typically have a good call base around those round figures, which is 8,000 might see a strong call base, and that might deter you. But if you're willing to see past that and hold it for some time, then not a bad idea to continue and hold.
Right. So that's this long trade coming in on Siemens from
the other stock is pending, right?
Correct.
Yeah, sorry. Go on.
So one more to add to the buy list, which is VA Tech Wabag. I mean, we know the stock has been a multi-bagger from 400 to about 1,700 odd in a year and a half's time. So it's already been doing well. Every dip has turned out to be turned out as a buying opportunity. At the moment, this is a buy on rise kind of a setup. The volumes are picking up, the stock's gaining momentum, the momentum indicators are fairly positive. So from a near-term perspective, 1755, 1810 targets, and your stop loss being 1650. So Siemens and VA Tech Wabag.
Siemens and VA Tech Wabag. Those are 2 buy calls, long trades coming in from Kush. He also believes that Siemens are looking so good that you may consider this trade in the option space as well. But it's going to be a day of earnings, and the only Nifty company reporting is Bajaj Auto. Remember, we just talked about how the auto sector has had its worries in the last couple of months with those auto sale numbers not looking very promising. But hey, we are in the midst of the festive season, and this should be providing some support. But that, of course, may or may not be reflected just yet. Puneet is standing by with more on the expectations that we can have from Bajaj Auto. Puneet, what do we have? What is Citi expecting from the whole bunch? And also with Bajaj Auto in particular, what are we expecting today?
Well, definitely, so Bajaj specifically is going to be a very strong quarter for the company. Highest ever revenue across the auto sector is what's expected from the company. So they are expecting a 22% growth in revenue for Bajaj Auto. This will be also followed up by a 26% EBITDA growth for the company, while also leading a 20% PAT growth for someone like a Bajaj Auto. But I also want to just divide the segment of auto space into 2, because there are going to be some key winners and some key losers as well. Let me start with the winners first. We've already spoken about Bajaj. TVS is also going to be the other player. It reported a 14% volume growth in this particular quarter, and that's reflected in the strong growth numbers as well as EBITDA growth as well. You can see that the operating leverage play for TVS is reflected in the numbers, expecting a 23% EBITDA growth and a 28% PAT growth as well. Another key winner will be, of course, Hero and Eicher Motors as well. Now, while sales growth has been lower compared to TVS and Bajaj for both these players, they have been able to capture roughly about 10 to 12% volume growth in this particular quarter, and that's also reflected in strong numbers for both these players. Finally, M&M is another big winner. Now, it has reported roughly 18% volume growth in Q2, and that's led by the 3X, as well as now the Thar Rocks that has been very well accepted by the market. So both these has been one of the key things as well. So Hero expected to cross 15% margins for the first time since the pandemic, so like roughly 12 to 16 quarters, while Eicher Motors, despite the lower volume growth, is expected to be good, and we spoke about Mahindra as well. Now, if you look at the key losers, I want to start with Tata Motors specifically, because it has three divisions that we look at. For passenger vehicles specifically, it's expected to report a 75% fall in profits, and that's because of two key reasons that they mentioned. One is, of course, higher discounts and lower sales volume in this particular quarter. The second is the CV division, the commercial vehicle division. Again, poor quarter, 16% revenue fall expected, and that's reflected in impact on EBITDA, and that's also because of lower volumes of about 16%. It reported in a fall of 16% this quarter. And JLR is going to be very interesting for Jaguar, because the commentary is what we'll be watching out for. The key thing is because both BMW, Mercedes have cut guidance for this year for volumes, but for JLR, they have said that they are expecting a better H2 in this particular fiscal year. So watch out for the commentary for JLR. Numbers are going to be subdued in this particular quarter. Finally, just to wrap up the conversation, the other key losers who will be in focus for auto specifically will of course be Maruti, because of lower growth, but it's roughly 2 to 3% fall in EBITDA and profits. But the tire makers are going to be majorly affected in this particular quarter, and Apollo is going to be the biggest loser here. They're expecting a fall of roughly 22% in profits for the company, while Seat is also 29% fall in profits, and finally JK Tires as well. Now, the key reason is because higher cost pressures as well as softer demand for tire makers has been one of the key issues, while Europe is also coming back on a much slower pace. So key winners we've spoken, one of them is going to be Bajaj Auto, that's going to be reporting results today, but watch out for the auto sector. Very divergent trends in this particular quarter. Back to you.
Okay. Puneet, that was a fast train or a fast car running through so many data points in about 2 minutes. So thank you so much for putting all of that into perspective. Now, Mayuresh Joshi Johnson, Head of Research at MarketSmith India. And Mayuresh, I want to take forward this point, because Bajaj Auto numbers come out today. Autos in general expected to have a, ho-hum quarter of sorts. Could there be an outlier within this pack? Because the larger belief is that most companies will not do well.
Morning, Niraj. Morning, Kush. Again, I think a very comprehensive review that your colleague has put out, Niraj. Two things to contend with. One, obviously, is the Shraddh period, where obviously the push through in terms of sales will be a little bit subdued, along with a soft quarter that is always expected for auto companies. But the other element is also, as festive seasons begin, a lot of auto companies start pushing their inventory through the dealer pipeline. So we've already seen, and I've already been talking and speaking to a lot of dealers, where the dealer pipeline has been quite sufficient in anticipation of how festive sales might be. So to that extent, TVS, Bajaj from the two-wheeler pack will have a stable show. Bajaj's management also sound very, very sanguine in terms of how the export markets are probably holding up. The new launches have probably worked in their favor, price realizations in their favor as well. And with input costs probably stabilizing at this juncture, the expectation is that the second half, along with festivities, can be a solid one. Similarly, for passenger vehicles, what we're probably seeing in terms of trend, M&M should continue their decent showing going forward. In terms of the mix itself, PVs should do well, specifically SUVs within that part of the PV segment. And tractors should also have a stable show and expected to do well because of better monsoons, reservoir levels even in the second half as the Rabi season begins. Last but not the least, auto ancillaries also as a pack, that can be a monitorable. So to answer your question, whether you hold on to two-wheeler stocks like a Bajaj, TVS, an M&M or Maruti, yes, maybe valuations a tad bit on the higher side, but can earnings start coming through in the second half, show stability and recovery in the next financial year? That seems to be a base case scenario. But auto ancillary is a little bit more sweetly placed, both in terms of OEM demand expected to remain stable, and the replacement markets needed holding up as far as volumes and pricing is concerned. So again, being a little bit selective here, but I think auto tank selectively as a pack should do a little bit better than core.
Mayuresh, hi, it's also Samina. Just a quick cue from what you said. So if you do feel like the second half could be good for the auto players, what happens to vehicle financing companies? They, of course, have had collections that have been rather slow on back of elections and the monsoon, the heat wave. But in terms of an outlook, What do you expect the Shriram Finances of the world to do? And of course, we also have Chandan Taparia, who will come to in a minute. So, Mayuresh, you want to just complete the loop there?
Yeah. Morning, Samina. Morning, Chandan. So I think to that extent, again, if you probably look at the NBFC universe, specifically servicing either the auto part or the auto segment or the rural discretionary spending as well, with better monsoons coming through, the expectation largely is that the Kharif output should be better, realization should be better, the MSP prices for few key cash crops should probably go higher. There is also some element that we are probably hearing about in terms of subsidies being rolled out in a fast-track fashion as far as seeds and fertilizers are concerned in terms of DBT transfers. That reduces the working capital cycle to a large extent. And farm gate prices have started holding off with input cost stabilizing. So to that extent, as rural spending starts coming back, the part of the auto universe and the NBFCs who service that segment should do relatively better. So I think the entire premise or the base case scenario is built on the expectations that urban markets will hold up and rural markets will recover. And therefore, I think the Shrirams of the world should probably benefit also from the fact that interest rates will start heading lower because of their pedigree, because of their credit rating, and because of the capital adequacy that they're carrying onto their balance sheet. The cost of borrowing becomes far easier to manage in a falling interest rate scenario, giving greater impetus to spreads probably improving in the coming few months.
Okay. Well, interesting points there. Before we take that break, though, Chandan Taparia is with us, Head Technical and Derivatives Research at MOFSL. Chandan, good morning. What's the view? Are you taking any trade on the benchmarks or are you looking at specific stocks?
Good morning. Thanks for having me. So if you look at the index, it got stuck in a range. On downside, we have multiple support near 24,750, while on the upside, hurdles are visible at 25,250. So we require a consolidative move for next couple of days to start the next leg of rally. If you notice the price behavior of last 7 to 8 weeks, the index rallied with support of 24,750 headed to 26,277. That was the movement of 1,500 points. Market surrendered the entire move and now has been consolidating and hovering near its 50-day mark close to 25,000. So I believe 2 to 4 more days may be there for this consolidative rally. And then about 25,250 market will start the next leg of rally on the upside. So I'll wait and watch for index to conclude beyond 25,250. But meanwhile, a stock specific action could continue to be in the market going forward.
That's the consensus. And then 25,234 was that high we made last week on Wednesday, and I've actually sold off from there. Even yesterday, 25,200 turned out to be quite the resistance on the index. So Chandan also believes markets in a consolidation phase until 25,250 is not taken out. Long trades not being recommended. We'll take a quick break. We'll come back and track pre-open and get a whole list of stocks for you to trade this morning. So stay tuned.
Thanks for joining in. This is India Market Open. Now, for people who are tuning in right now, just want to tell you, a clutch of stocks will be reacting today. We'll try and talk about some of those, if not all. There's a brokerage note on BSC from Jefferies. Cochin Shipyard has an OFS with a floor price of 1540. You'll maybe watch for that. A clutch of infrastructure names that Samina highlighted right at 8 a.m., which is PNC, Ashoka Buildcon, GR Infra might be very active in trade. There is Rallis, which has come out with a fabulous set of numbers. So, and a lot of brokerage notes. So, a lot of stocks that you want to keep in mind today. Now, before we talk about all of those, though, Chandan Taparia gave us his index view. Chandan, what are your stock recommendations for this morning?
So, looking at the stocks, we have positive view on the Nifty IT. Nifty IT index is doing well and holding the gains even after a consolidative move of the market. So positive on the SCL Tech. However, we also like Coforge and Dixon. But here, for trade point of view, I'm recommending to buy on SCL Tech. The stock has been making higher top, higher bottom from last 5 days. On weekly scale, it has given a breakout of last consolidative move of 6 weeks. So expecting further rally, one can buy with support of 1835 or an upside target towards 1940. Second trading area, there is sell on Tata Motors. The stock has been making lower top, lower bottom on the weekly chart. Even in last 4-5 days, it failed to surpass 950 zone. Sustained call writing is also visible. It has given the recent lowest close. So expecting weakness to continue with hurdle of 940. Tata Motors can drip down towards 880 marks. And one more trading ideas if we have to consider is buy on Siemens with support of 7720. And it can head towards 8200 zone in capital goods sector.
And then Kush as well has a buy call on Siemens. So we have a consensus buy call coming out on Siemens. And I think what I want to pick up on is HCL Tech with Mayuresh as well. Mayuresh, we saw those numbers from HCL Tech yesterday. Very impressive. Management themselves was pleasantly surprised, I believe, with what they reported. The stock made a life high on Friday. And, you know, I was debating this with Kush and Niraj, trying to understand what one should do when a stock hits a life high. Do you buy it or do you sell it? And Niraj told me that you follow the CanSlim approach where you actually buy stocks when they hit life highs. Tell me about this approach for people who want to learn more. And what do you think about HCL Tech while it's hit a life high? You also have a constructive call on this one?
Well, absolutely, Samina, I would love to. So I think what CanSlim really does is it blends fundamentals and it blends technicals as well. So I think a large part of our stock selection process goes through core fundamentals. So 60 to 70% weightage is obviously left on fundamentals and leaned on fundamentals, how earnings are, how earnings have been, the positioning of that stock in the industry that it is. Does it have a leadership position? And will the earnings continue to grow at a good pace? As it has historically done. Now, we use technicals to probably time our entry for the stock, and we've got a predefined exit route in terms of risk management as well. So I think this approach devised by William O'Neill has worked wonderfully well for 60 years in the market, Samina. And as you said, our approach is buy higher, sell higher. So I think I would be optimistic on HCL Tech if a stock hits an all-time high, has a leadership position, has earnings, which has been a strong forefront that is backing the price move. And if technical indicators are suggesting that the stock can be entered into, you probably then enter into that stock with a 20-25% upside and keep a stop loss of 7 to 8% from our entry.
So that's the view on HCL Tech. The stock was muted yesterday post earnings, but it's up about 1%, 1889 in pre-open. We had a quick check on how the Nifty is doing in pre-open. It's expected to be starts up 25,000, so we may be a little disappointed if we see that on the screen. But no, actually, it's not doing too badly at all. So while implied Nifty was indicating to gap down on 70-80 points, pre-open is not looking half as bad just yet. There will be stocks and there will be a whole host of them to watch. Chandan, let's very quickly go through the list of counters that have bagged orders from the Maharashtra State Road Development. Ashok Bilkon, I know it's from the state government, but not sure if it's the road part. So I'll add Ashok Bilkon, GR Infra Projects, PNC Infra, and Seagull, if you track that too. And Railtel. So I've given you 5 stocks on order wins. Anything that looks good on the charts?
So let me check the price behavior of the Railtel. It has been making lower top, lower bottom. But already we have seen a decent corrective move from the higher levels. And it has made the bottom near 385 in the last week. I believe follow-up is required, but the bottom process with bullish setup from mechanical indicator indicates some surge in the counter. So with support of 398, we can see an up move towards 434 kind of level in Railtel. Talking about Ashoka Buildcon, it has seen a breakout and momentum is visible on the weekly chart. The stock is already up by more than 80% in this finance calendar year. Momentum could be there. with support of 235, it can head towards 275 to 280 zone. So these two will be preferred name out of all these 5 stocks.
Chandan, quick one on SBI, and then I'll come to Kush on SBI too. So you want to just quickly go with your take on the counter?
So SBI has been consolidating in a range from last 27 trading session. It is finding hurdle at 50 DEMA, but the good part is supports are intact and base is shifting higher. We have noticed sustained call writing at 800 strike, and 4 times or 5 times in last 13 days, it failed to hold beyond 800 marks. So it requires a decisive hold above 800, 810. Above that, it may start some short covering to 830. So conditional trade, hold above 805 to 810, and see an up move and short covering towards 830 marks with support of 792.
Okay, the other stock to monitor just before we get into the big brokerage call of the day is HDFC Life. Now, Citi has a note, and we should pull up those graphics. Citi has a note. They have a buy. The target price has been raised to 820 because Citi says that the management expects the 2H margins to be higher than 1H. They have retained the VNB growth guidance at high teens. And Citi for itself is raising the VNB multiple to 20 times from 18 times. So we should get those graphics on air of the Citi note. Even when I'm asking Mayuresh Joshi about this. Mayuresh, HDFC Life got sold in trade yesterday. The commentary is positive. Would you buy here, or are there better opportunities?
I would wait it out. Obviously, Niraj, what has happened with numbers is you've seen the VNB margins actually come down from 26.2 to 24.6%. And a large part of that that drawdown would probably have been because of marketing stroke other commissions stroke other expenses percentage actually moving higher from 19.6 to 21.1%. And that's an obvious reaction because as they are trying to push in new products because of the budgetary changes that have happened a year and a half back, you are going to see these expenses remain elevated onto the balance sheet. Obviously, protection and the annuity part of the business has now come down to 44%. But as the product mix evolves over the next few quarters, you're still going to see elevated expense numbers onto the balance sheet, which might actually pull down VNB margins. Yes, embedded value has crossed 50,000 crores. You are seeing a decent growth in terms of overall renewals. And therefore, I think both in terms of the bank insurance network that they're probably, or the agency network that they're probably expanding, numbers in terms of how VNB margins are, numbers in terms of the overall growth in embedded value might still remain restricted for the next couple of quarters to say the least. So a decent move has already happened onto the stock. My own sense that it might consolidate. SBI Life, better placed on most of these parameters in mind.
Okay, watch out for HDFC Life. Flat as a pancake, right? SBI Life is flat. HDFC Life should come up on the screen as well, about 1.23%, so a bit of a recovery there. Wonder what BSE is up to because it's had a massive uptick in the recent past, down 2% today. Harsh, is the Jefferies note? Could that be the reason? What is Jefferies saying?
Well, a massive downgrade, Niraj. Jefferies has been constructive on this counter ever since they've initiated coverage. This is a substantial downgrade now from hold to underperform. They've hiked their target price though, and that's a possible positive. 2,850 rupees was the earlier target price, currently sits at 3,500 now. But just in terms of valuation, not finding enough comfort is what Jefferies is suggesting. First off, the stock has run up from 2,200 just 3 months back. Stock is currently sitting at 4,500 plus. What Jefferies is suggesting on the back of that is that valuations have run up much more on the back of SEBI's new F&O framework. Now, the framework itself should impact overall industry volumes by 25%, which they believe the street is not penciling in. Even if a 40 to 50% market share is what BSE captures, it still means that the stock is currently fair valued. And I'll come to that bull case and the assumptions which Jefferies makes on that. But Jefferies currently puts the valuation at 40 times earnings, and this is FY26 earnings. EPS is what they're penciling in at 86 rupees a share, and at 40 times they're valuing it at 3,500 rupees per share. In terms of valuation comfort, they believe it's stretched, fails to capture risks and the higher impact on overall market. Therefore, they believe risk reward turns unfavorable. Now, in terms of the bull case that they are talking about in the note, 4,800 is the target price in their bull case. 55 times is the multiple they're giving it at the same EPS. They are expecting a revenue CAGR of 45% if this were to play out, EBITDA CAGR of 70% and improving margins, and a PAT CAGR of 60% if this were to play out all the way through FY26. So they believe that risk reward currently unfavorable, of course, likely knock on the stock today.
Let's pull up there you go. Thank you for that, Harsh. The stock in pre-open trade is looking like it's going to get a rough start of nearly 4% cut is what we're expecting. Kush, you track BSE. What does it look like on the charts?
Before that, Samina, let me put Mayuresh in a bit of a spot. Let me take that liberty. And, might I suggest a masterclass on CanSlim, from Mayuresh, among hundreds of others who will. I know a couple of candidates, who will for sure benefit from that masterclass. So, Mayuresh, putting you on the spot there. Coming to BSE, well, I agree. I kind of agree with the Jeffries note. However, my view is not as pessimistic as 3,500 just yet. There are negative divergences on the daily setup. The weekly setup, is seeing overheated levels on the, momentum indicators. So, yes, a pullback is for sure warranted. If you have, not a bad idea to book, exit right now and then perhaps revisit it close to 4,000, 4,200 kind of levels where the 20-day moving average resides, and also there is some buying support that might kick in. So if you want to re-enter, don't be in a hurry to buy immediately just because the stock is off about a couple of percentage points. Closer to 4,200, 4,000 range is where the risk-reward ratio becomes a little more attractive.
Well, don't be in a hurry to buy the counter. There should be some more weakness expected, so keep an eye on this one. Well, the other few that we should be tracking are the ones on auto wins. If I can quickly pull up Ashok Bilkon, PNC Infra, GR Projects, those should be seeing some sort of an up move in early minutes of trade. Ashok Bilkon up 2%. You've also got the whole bunch of other counters that have backed orders. PNC, look at that, 5% up move in early minutes of trade. GR Infra up 2%. Well, another few names that are on our radar this morning is going to be Cochin Shipyard. Chandan, is there an opportunity to go short on Cochin Shipyard? You have an OFS, a divestment from the government at a nearly 9% discount to yesterday's close. If we do get a flat open on Cochin, would you recommend a brave heart to consider shorting the stock?
So Cochin has been making lower top, lower bottom from last 14 weeks. I believe some sort of support could be there. I don't want to go against the major trend. However, the short-term trend is negative. So I'll play with conditional trade setup. If it moves above 1725, I don't want to look back. I'll go with the positive stance. But if 1725 is not broken, then it can retest to 1500 kind of level on the lower side.
What about, I'm just going to quickly go through stocks with you. What about SBI? A quick word on that. I think we talked about it. Is it looking like you did indicate that it's looking like a good long trade, right? If I'm not mistaken.
Yeah.
Yes.
Yeah, so SBI requires a decisive breakout.
Okay.
It has been finding support, but finding hurdle at 50 DEMA from last almost 12 days. So small follow-up beyond 805, 810 could open the target towards 825, 830. So with support of 792, 794, one can go over the long side in the counter.
Chandan, HDFC, ICICI and Kotak, what is your top pick today? For the day or for the next few days?
I'll focus on ICICI Bank. The stock is bottomed out after a corrective move from 1362 to all the way to 1270. It has negated its lower top, lower bottom. Even on the weekly chart, we have formed a strong bullish candle near the support zone. So ICICI Bank will be preferred pick with support of 1225. We are expecting a run up towards 1310 in ICICI Bank.
HDFC AMC is the other one, by the way, which should be in focus because I think CLSA has upgraded HDFC AMC and therefore keep an eye out for that one as well. Angel One had a big move. Mayuresh, now you should have no qualms in talking about Angel One. Maybe 4 years ago, yes. Just a thought here. Blowout commentary. The stock zoomed in trade. What does one do now?
Yeah, so before that push, always welcome for a masterclass on CanSlim. You tell me the time and we'll do it. On Angel One, Niraj, obviously I think the performance has been stellar in terms of the customers that they've been adding. And the customers they've been adding have been through the digital process. So I think it has hardly added any cost element significantly onto the balance sheet. And at the same time, what we've probably seen in terms of overall numbers have remained extremely stable. And now with the tweaks that have probably happened in terms of semi-norms, does that create a huge amount of impact in terms of volumes? But to a large extent, a few of the brokers have already started inching up their prices, both in terms of transactions, and as well as the other charges as well. So to that extent, I think the compensation part in terms of all volumes might actually get reflected. But we'll have to really see how this really plays out in the next 2 quarters. So again, anybody holding on to this counter can definitely hold on. But watch out for key monitorables as earnings fold out over the next couple of quarters.
It's not just Angel One. Look at how Anand Rathi as well has reported numbers. It's become the new HDFC, reporting 30% quarter on quarter. Chandan, a minute to go. Your top trade this morning, long or short?
So I'll go long in counter and can focus on Siemens with support of 77.20. We are expecting a rally towards 8200 zone.
Siemens for you as well. It was your top call this morning, I think, at 8 o'clock at least.
Yes, it was. Continues to remain, but we can also add Shriram Pistons, a good recovery underway on this one with a stop loss of 2150. You could gun for targets of 2350 and 2500 positionally.
Okay, Siemens, Shriram Pistons amongst the top calls. Remember, a lot of stocks in focus today. So what was on our watch list? A clutch of names really, from a BSE which has gotten a downgrade to a Rallis which has delivered a good set of numbers to a bunch of other stocks. And I think all of those would be in focus on a day when we're starting off on a very flattish kind of a note really. So here come the first rates and we will have a morning in the red. Banks about 0.25% lower as well. What about Nifty IT? Should come up on your screen. Is it getting a leg up from the ISG data? Will come up in a moment, the Nifty IT, because Sensex and the Nifty are certainly in the red. Nifty IT, well, not really, down 0.5% yet again. Bring up the mid cap and the small cap indices to see if the breadth is better. Remember, small cap index was up a percent yesterday. Flat currently. Okay, seems to be a flat day. Let's get the heat map and see if there are individual pockets moving or no. Well, the top loser is M&M. Then Infi TCS correct as well, tightened down, but no big shakes. That's what I'm saying. It's even Stevens, green versus red. M&M is the top loser, down just 1%. Nothing too dramatic. There's Cipla, IndusInd, ICICI Bank, which was a hero yesterday, down in trade. Reliance continues to sulk. Adani Port down in the red as well. So that's the set of stocks which are correcting. What is doing well? Life insurers, SBI Life and HDFC Life. Bajaj Finserv. So it's life insurance companies which are doing very well. BPCL and Asian Paints from the crude sensitive pack doing okay. Some strength in Hindalco in the session today. But it's very, very flattish on the large caps. Samina, I wonder if mid caps have a better outing today.
They're okay, but I think rather flat than falling off the cliff, right? We're holding 25,000 and that may not be too bad a thing this morning. And remember, that turns out to be an important level of support where we usually find support at, and exactly what we're getting in this morning too. Crude sensitives we highlighted for you will be a good focus to talk about. A 5% decline in crude means OMCs like BPCL, HPCL that have been gaining over the last 2 days continue to do so today as well. You've also got paint companies, Berger, Asian Paints are counters you want to track from the crude sensitive basket. In terms of the market, the Nifty 500 is not showing fireworks this morning. Lots of counters that are moving, but no big gains coming in terms of trade. Sectorally as well, the WIX, of course, is up slightly. Metals are holding okay. Remember, it's all eyes on China's stimulus that will be announced tomorrow. Oil and gas looks okay. PSU basket banks, I've talked about this, of how counters like SPI have failed us over the last couple of days. But this morning, the Nifty PSU bank index is not doing too badly in trade, at least outperforming the private space. Nifty IT sells off. FMCG continues to look weak. And you've got, of course, the other spaces like consumer durables and healthcare that look rather muted as we see it. In terms of the stocks I've got that we are tracking, let's start with what the brokerages have had to say and how that's impacted a whole bunch of counters in trade. So BSE got a huge downgrade coming in from Jefferies, on back of which the stock is not having it too badly, but it's down 4%. HDFC Life numbers were disappointing, or at least the street was disappointed yesterday. There was the brokerage report that doesn't seem too disappointed. The stock did get a gap up, but that's got sold into in the last minute or so. And Newgen Soft, again, numbers were okay. Stock was lower yesterday, but the management commentary was actually very, very promising and convincing. And that is leading to a little bit of an uptick in early trade. Remember, the market breadth and the sentiment is not very positive this morning. So even if there are very conclusive reports coming in, these stocks may not react as aggressively on the upside. It's all about order wins. I've talked talked about how this week has been about the Maharashtra state government giving out orders lock, stock and barrel, and you can see the stocks reacting to that. PNC Infra, 4,500 crore order, the stock is up 5%. GR Infra, another big order win there, 4.7% higher. It was, I think, 1,800 crores if I'm not mistaken. Railtel, small order, only 80 crores, but look at the stock. It's doing a good up move of 3.5% in trade. So everything to do with order wins is seeing an up move. Ashok, Bilkon and Siegel, I'm going to add that to the list. Even though they didn't come from the Maharashtra government, both those counters have managed to bag good orders. Ashok Bilkon was also on the winning side early this week. Continues to see that coming in early trade this morning as well. Well, along with that, that's Ashok Bilkon for you, a 3.5% up move on that stock. Well, apart from that, you've got action-packed stocks beyond what we have in terms of today's trade. So you've got Cochin Shipyard. The government is looking to divest 5% stake at a 9% discount to Tuesday's close, on back of which the stock is seeing a downtake of about 3%. KEI Industries, numbers haven't gone down well with the street. They've also talked about a fundraise plan of about 2,000 crores, on back of which the stock is getting hammered this morning, 4.5% out. Fantastic set of numbers coming from Rallis after a very long time. So the little bit of euphoria and excitement is very obvious on the stock. The counter trades the gain of 9%. So Niraj, I think everything we highlighted this morning is the top stocks to watch, and I'm pretty glad about that, even though some are on the sell side.
Yeah, but Rallis certainly, and I think that what Rallis has done is probably gonna work for the space at large. It's not just a Rallis specific move, I think. Look at that surge. And remember, this is a surge coming on just a 20% uptick in PAT. It's not a mammoth doubling of profit after tax, but it's just that after a really long time, you're seeing Rallis perform. And I wonder if really holds true for the sector. By the way, the stock that's falling is the one with the OFS, which is Cochin Shipyard. I think that stock has come off. But, you know, I can't take my eyes off Rallis today. 10.5% up now. Mayuresh, I have to come to you on this one. What Rallis has done, one, whether it means positive for the stock even after the 10% uptick. But two, would you think that what Rallis' show means positive for the entire sector at large?
Can be a base case scenario, Niraj. So I think the entire sector might do well for two reasons. One, I think the volumes will be significantly higher. Again, the base case scenario is that the monsoons have been very, very decent, as we've seen in the past quarter. And again, with good reservoir levels, the expectation largely is that even in the second half, as Rabi sowing begins, you're going to see a large part of that agrochemical market, stroke fertilizer, stroke seed market actually do well, even in the second half. So I think the expectation that largely got restricted a few quarters back in terms of lower volumes, lower farm gate prices, higher input costs, the entire equation is now probably reversing with higher volumes, higher farm gate prices and stable input costs, which probably means that leverage, margin expansion and earnings expansion might be on the card. So yeah, I think, this space looks very big.
HDFC Asset Management is seeing a good up move, 5% high. Quickly want to take a check on Siemens, because I think we had a few buy calls this morning on Siemens. Chandan, Kush, both of you want to go? You want to first go with this, Chandan? It's open flat. Looks good still for a long trade?
Yeah, looks good. Comparatively, both the counter, which are on the long side, Siemens and SL Tech are doing well. I'll keep the support intact. 77.20 is the support for target of 8200 zone. One can hold. Even for intraday, one can trail stop loss to today's low level to continue with the positive stance in the selective sector in the stock.
It's the only tech company that's doing okay, at least on the Nifty 50 this morning. Everything else in the tech pack is trading lower. Even HCL Tech is flat, so we shouldn't get getting too excited just yet. BSC is taking to the chin, 4.5% rower. Kush, tracking Rallis, 10% up move on Rallis. Looks good for a trade, you think?
Well, not from a near-term perspective, and by that I mean today or perhaps even a week or two. Might just look a little interesting if it cools off back to those 345, 350 kind of levels. There is gap up, there is volume on the back of news, but I think now you're hitting that resistance mark of 360 to about 365. That's a resistance zone. So let it cool off a little. Then from a trade perspective, it might start to look a little more interesting. Just a quick word on Siemens. As Chandan said, not a bad idea, 0.5% up, but if you've not got a long position, not a bad idea to build one. look at VA-Tech Vabag. That was the other stock we discussed, in the morning for an opening trade. 1755 was the first targets. Now it's overshot that. But if you haven't gotten into it already, then you could still play for 1810, 1850 kind of levels. As I said, this is one stock that you might want to hold positionally in your portfolio. Now the closing yesterday will start acting as your stop loss. So VA-Tech Vabag, something that you want to consider for a long trade.
Just a quick mention on AMCs. While HDFC AMC probably is leading the gains in the AMC pack, it's not the only counter. HDFC AMC is up 4.5%, but you've got the other host of AMCs as well. So Nippon UTI Asset Management is up about 2%. Nippon Life Asset Management is also looking good with a 2.5% up move. So you've got sporadic good gains coming in the pack of insurance and AMCs. Mayuresh, do you feel like for the next, I know it's tough to get a short-term call from a fundamental analyst, but this is all about sector rotation, right? Are you still seeing value in AMCs and insurance companies?
AMCs, yes, Samina. So I think the SIP numbers are continuing at a very, very robust pace. And what really happens is, as the SIP numbers start coming through, both in terms of a large contribution coming in from equities, because of the momentum that we are probably seeing in the markets, and some debt inflows as well. Because their businesses have been well established over the periodicity of time, I think a large part of the incremental benefits from incremental flows directly flow down to margins and the bottom line as well. So I think a huge element in terms of fixed costs have already been gestated onto their balance sheets as their businesses grew over the last few years. And therefore, any incremental volume growth that we are probably seeing in the businesses will reflect very, very positively in terms of margins and bottom line. So as we track at Markets Related, VPS ratings, RS ratings have been very, very solid for AMC companies and might remain so, at least for the foreseeable future. So yeah, remain positive on the AMC space.
Okay. I wonder if there can be a trade given for rallies and now. Kush, come in. I'm making a difficult thing, but this is a stunning move on a stock which is moving after ages. What are your thoughts here?
So again, Niraj, very good move, very solid move, but now it's entered those recent high levels of 360, 365. You don't want to enter a trade more on an emotional front, more on an emotional count. Just let it cool off a little. I think a good level to enter will be around 345, 350. The stock will still be about 8% higher, 7-8% higher, from yesterday's closing. But from a risk-reward perspective, that will give you, a much better risk-reward ratio. Now, once this stock takes out this 365 level is where you'll see further momentum. So at the moment, if you've got an existing position, not a bad idea to book partially, hold the rest for a fresh entry. You're looking at a level of 345 or thereabouts to make a fresh trade.
And then
HDFC Life, Samina, just want to mention just that, because HDFC Life is now perking up in trade. 1.5% higher.
AMC and insurance across the board need a trending badly. Look at ICICI Pru as well, 2.5% on that counter. So now whether it's these earnings and the brokerage view on an HDFC Life, AMC that's helping the sector is probably what's leading them higher, but they're all looking good. That whole pack is the only space that's holding up in the financial ancillary pack. Chandan, have you identified anything in the first 10 minutes of opening? Anything that was not talked about before market open?
Yeah, I'll focus on MCX. We have positive stance in entire capital market sector, whether you talk about exchanges, broking houses or depository or AMC. So MCX already has been making high tops, high bottom, rallied well by more than 100% in this calendar year. Still up move and threshold could continue to take the stock on upside. So with support of 64.20, we are expecting this run up to extend to our 6800 zone in MCX.
Okay. So MCX, and fundamentally this has done well too. Mayuresh, actually very quickly come in on MCX. It's an interesting point that Chandan makes. Chandan, actually we can let you go. I understand you have to go. So thank you so much for joining in today. Really appreciate your time. But Mayuresh, I want to take off the leaf from where Chandan left off. MCX, the volume data quarter on quarter, quarter 2 over quarter 1, quarter 1 over quarter 4 of last year, the volumes have really shot up in trade. What's your sense on MCX fundamentally?
Commodity trade is that the volatility in those markets should continue. So if volatile markets are expected to continue, you will see huge amount of volume growth continuing on MCX. if the volumes or the volatility stagnates, the volumes stagnate. We've seen that in the past. But what is probably happening at this juncture in terms of geopolitics, what is probably happening in terms of the entire space in general, I think volatility will be the mantra that will continue going ahead as well. And as volatility continues, there is a huge spurt in volumes that you see across precious metals, across base metals, or otherwise as well. Again, introduction of further new contracts is something on the cards as well that can get introduced over the next few quarters as well. That adds an element of spice in terms of what MCX can probably offer to a lot of traders on the commodities exchange. So yeah, I think with volatility expected to continue, volumes expected to remain higher, the ATT or the average daily turnover should remain relatively high. Again, from our perspective, I think the stock has moved a tad bit too much from key pivot levels. Anybody holding can hold on, but have your risk parameters.
Okay, Mayuresh, we'll leave it at that. Thanks so much for taking the time out and being with us, Mayuresh. Now, we about to hear out from HDFC Life. Harsh will be in conversation with Vibha Padalkar. 20-second answer, Kush. What about HDFC Life charts?
It's consolidating. The range is 710 on the downside, and on the upside, you're looking at a 740. If it breaks this range on the downside, then there could be a bit of a pressure. Consolidation on, buy only for a medium-term perspective, not a near-term trade.
Okay, go across to Harsh for this conversation with HDFC Life. Harsh, over to you.
Thanks. Good morning. We have with us MD CEO HDFC Life, Ms. Vibha Padalkar, and quickly on growth, ma'am, if I can quiz you, because growth has been stronger both for Q2, H1. So does your full year guidance therefore change? Does it give you more confidence to hike your growth guidance?
Yes, we are fairly happy with our growth in H1, and it has been fairly consistent at 31% growth in Q1 and in Q2, and hence in H1. Also, as a result, our market share has expanded to 16.3%, and very happy to share that we have reached a new watermark of 11% market share in the overall industry. This is the first time in this H1 that we have reached this watermark. So yes, holistically, quite happy with the level of growth. In H2, we will continue to go ahead and drive this momentum that we are seeing in our sector, especially after quite a few of changes, whether in taxation, whether in regulations, and so on. So we are fairly hopeful of driving this momentum. We should end the year at least at an 18 to 20% APE growth, and also slightly faster than the overall sector.
Point taken. What about value of new business, ma'am? What would that growth look like? You've upped your guidance on top line.
We have delivered value of new business growth of 17+%. We expect on a full year basis at least to deliver VNB growth in the region or somewhere in the range of 15 to 17%.
And ma'am, margins have come off for you. You expect margins to taper further by end of this year, given the kind of growth guidance you're suggesting. It could see a further taper. Could you give us perspective as to why that is so? Because you're not meeting your guidance.
So a couple of things, like I've articulated, we want to take advantage of the growth momentum that we are seeing. At the same time, equity markets remain fairly buoyant. And we are following a strategy wherein we want to be where the customer is and offering products that the customer is enthused based on whatever is the economic environment that the customer is looking to buy. And hence, the level of unit link has gone up to some extent. Normally, it's about 1/4 of our business. It's hovering around 1/3 of our business and thereabouts, about between 33 to 36%. As a result of which there is some softness in our margins, but in order of priority, we are targeting new business growth followed by value of new business growth, like I articulated, in the range of 15 to 17%, and margin will be an outcome. Why are we doing this? We are doing this, like I said, because it is important that we get customers through the door. It's not that difficult for us to stay range bound to a particular margin, but that would just mean that we would have to say no to business that's otherwise accretive to value of new business. So triangulating all of these different objectives, we're saying that we will continue to grow. Another very interesting point is that of the new customers that we added this year, over 70% are new to HDFC Life, and that just revalidates our strategy to say that it is important to get the customers through the door to sign up in any which way with one of our policies, and thereafter to see how we can deepen our relationship with the customer. And that's exactly what we are successfully doing in this year.
So, ma'am, point taken, but where should margins therefore be at the end of FY25? Because you've guided for 100 basis point likely maximum impact in case as surrender value norms kick in. So where should therefore margins be? Do you expect a further taper of 100 bips due to the surrender value norms kicking in over and above what you're guiding for?
Yeah, so on margins, we ended last year at slightly over 26%. I had said that allow us to be range bound. It could be 100, 150 basis points lower as long as I'm able to give growth that I've demonstrated is higher than the sector. That's number one, as well as VNB growth. We've delivered 17% VNB growth. So that's if surrender regulations don't happen, we will continue to be range bound, like I mentioned, versus the margin profile last year. And just to put things into perspective, if I were to look at H1 of last year, unit linked was about 28% of our composition versus about 36% of our composition this year. And that kind of explains the softness in margins. This is, of course, without taking into account surrender charges. What we had mentioned is that if we did nothing, then the impact of surrender charges on a full year basis would be 100 basis points, on our margins. Now, obviously, we are not going to not be doing anything, and we are in conversations with our partners, and we will try and see how we can reduce this impact on our margins. But it will take about a quarter because we've just gone live with some of our products. There are these ongoing conversations with various partners that will crystallize and settle down in a quarter's time.
Right. So, ma'am, are temporary factors pushing you to shift focus away from margins? And my question, therefore, is will margins revert back to 25 to 26%? I understand timing may be fluid, but are you confident of margins coming back to 25, 26% plus?
Absolutely. Because I'm very confident that, the unit-linked uptick that we are seeing is a market phenomenon. And as and when the cycle turns, and cycles will turn, we are fairly confident that our sales teams can virtually switch to various other products that we have in our arsenal, depending on whatever is topical at that point in time. And as that happens, margins can only move upwards from there because unit-linked, as one knows, do deliver fairly low levels of margins. So it's just that triangulating between growth, margins, and value of new business, we do see any pull back on unit-linked in favor of, it could be par, it could be non-par, it could be annuities, pension, whatever anything other than unit-linked will mean better accretion to margins.
Fair point. You've spoken a lot about product mix, but is pricing at all causing a drag on margins?
So the drag was really in quarter two, in the last couple of months of quarter two. And I did mention this on the call that there has been an impact on a standalone basis in quarter two. There's been about 100 basis points impact on margin. This was a conscious call because these were on non-par products that were going to be phased out. Post the regulatory changes, they would have been phased out. Now we had to reprice those products, but we only would have ended up not being ready on 1st of October with the newly compliant products. So we prioritized 40 products that would now be compliant, and we are able to sell those products. Had we gone to reprice the old product, the old non-par products, then we would have had to prioritize and perhaps put a new product on the back burner, and we consciously chose not to do that. And that's had a 100 basis point impact on standalone Q2 and about a 30 to 40 basis points impact on H1. But that's been a one-off situation.
Right. So margins otherwise, ma'am, sequentially would have been flat. Is that the right way to look at it?
That's right, more or less, yes. We ended 25% in Q1.
Yes.
And yes, more or less that would have been the case.
Right. And will you adjust for pricing in second half of the financial year? And therefore, is it right to understand that margins will recover and this is likely the bottom?
All things being yes, but unfortunately things are very fluid, like you mentioned, and so we'll have to see how the new surrender avatar, in terms of the new products, how that pans out, both in terms of conversations with some of our or most of our partners, 300 plus partners, as well as customer pricing. I'm hopeful that our peers are fairly restrained in terms of the kind of IRRs as well as the conversations with partners, as we will be. And so that should not cause inordinate pressure on margins. We don't expect it to, but we will know for sure as we progress in this quarter. And of course, the unit link will remain in the 30s, unlikely to go up to 50+%, like is fairly common amongst some of our peers, but it will still be somewhat elevated in the high 30s.
Okay, thank you so much, ma'am, for setting up a good perspective with regard to what's happened in Q2. Thank you so much for joining us this morning. Well, back to you, Niraj.
Okay, Harsh, what stood out in this conversation?
Well, what really stood out, it seems, is that two pressures which is basically keeping margins subdued. One is the fact that you've got a huge shift in product mix towards unit link, and second is that product pricing hasn't been tweaked. If any of those change, likely margins will recover. So hopefully H2 should be a better quarter, and that seems to be even what analysts seem to be suggesting on the street, that H2 will likely be better for HDFC Life where margins is concerned. Growth, of course, extremely strong, so no concerns there.
Yeah, it's showing the way the stock is performing as well, up about 2.5%. So thanks, Harsh, for putting that into perspective and for that conversation as well. Vibha Padalkar, head honcho of HDFC Life, with us on NDTV Profit. Flat markets, but recovery from the lows of the day. Great time to get in a very special guest coming on media after a really long time. Parag Thakkar, fund manager at Santulan Investment, with us in our studios. Parag, so good talking to you. It's been a while. Thanks for joining in.
I am also really delighted to do a show with you after a long time. It has been a great pleasure.
Thank you. Look forward to the next 15 minutes, Parag.
Yeah, sure.
Trying to think, how do you think about the markets currently? We'll talk about some high-flying indicators first, but it seems that the market is caught in a very narrow range.
Absolutely.
What happens next?
So basically, why it is in a tight range, I would like to address that first. The Fed has turned dovish. And first rate cut of 50 bips clearly tells you that they are very serious. If you remember what Powell said on that day, that US economy is already on a solid footing and we want to keep it there. And that's why the first rate cut was 50 bips. Right? So they are very serious about job market and they are looking at it very seriously. So that is a big positive in my view. Recently, from last 15 days, we have been hearing about China, right? China trying to improve its economy. I'm hearing that tomorrow, again, there's some meeting for improvement in the property market. So globally now, everybody is waking up to the fact that the growth is slowing down. And you need to boost economies, you need to stimulate economies through interest rate cuts. Of course, it is easy to do a monetary easing. Fiscal stimulus is difficult right now because debt to GDP ratios of the world are high. So, in between also there was a talk of $283 billion stimulus in China, but the number did not come. Yeah, because everywhere there is a pressure on government to reduce the debt to GDP. Right? As we call it in the company is net debt to EBITDA. For government, it is debt to GDP, right? So that debt to GDP is a problem. And so to fiscally stimulate the economy is difficult. Monetary wise, you can also always reduce interest rates. And we saw that in India also, RBI changing its stance from withdrawal of accommodation to neutral, which is a good change, good stance change at the right time, I would say. And the other point is that stocks have run up. So basically, we have defied the traditional logic, right? Earlier, what we have read in Warren Buffett books and what we have understood is that when interest rates rise, the PE should come down. But in the last 3 years, in US, the interest rates went up by 5%. But the PEs have not corrected. They corrected in between during the Russia-Ukraine war, but they again went back because Fed was printing money from 2009, global financial crisis, right? So the wealth effect took it over.
Yeah.
And so even when the interest rates went up, the PEs went up. So now we are at a stage where interest rates are going to get cut. But growth is definitely going to be a little bit weaker. And so the question is whether everything is priced in or not. And in India, to be specific, from March to September, you will not see any outliers in terms of big growth, right? So, for example, if you see September quarter earnings, most of the companies like cement sector or banking, everything will be muted. Cement will be bad, very bad, but banking will be muted, hardly 10-12% growth. And we are coming from a 30-40% growth time. In fact, this is for example, Mr. Uday Kotak told that we are in a Cinderella time for banks, right? If you remember, is one of his calls. And at that time, the stocks were not performing because FIs were selling because interest rates were going up. And this is that Cinderella time is almost over now.
So Goldilocks is used for the US and Cinderella is for us, is it?
Yeah. And the valuations have also corrected. For example, if a stock remains at the same price for 3 years, which is in the case of, say, HDFC Bank or Kotak Bank or some of these banks, the book value has actually increased, right? The underlying valuation of the company should have increased. But you can attribute it to the fact that because interest rates were going up, FIs were selling, and so the stock prices were not responding to the earning growth. Right? Okay. So that is why there is a confusion in the market. In my view, what can change this is, from the positive side, if there is a global growth which comes back because of the monetary easing, and of course, hopefully some fiscal stimulus in China also, and in India also, because of the election, the heat wave, monsoon, all these three factors remain behind, and now, hopefully, we see slightly more improvement in the liquidity in the market first, and then, of course, followed by some rate cuts, hopefully by Feb. And government spending, which was actually absent from election time. Right. So if government spending comes back, then you can see earning growth from Q3. Festive is also there. So Q3, Q4 might accelerate earnings. September June and September were bad quarters in terms of earnings.
Parag, but the fact remains the Nifty is up 27% in the last 1 year. So we've very obviously borrowed returns from the future. Towards the end of last year, we've been talking actively that, the markets are going to correct. It's wise to sit on some cash, take profits off the table. Now, what has happened is defied reality to a great extent. In your opinion, have you been sitting on cash? And if yes, how much? And are you beginning to allocate that cash? Because while the Nifty is only corrected 5%, stocks have dipped 20 to 30% in the last couple of weeks.
Yeah. So definitely we were sitting on cash. Across the portfolios, we'll be having 8 to 12% cash. And that we always keep because if some geopolitical tension arises, then on that very bad day, we would love to deploy cash.
Have you deployed in the last 2 weeks?
Slightly, yeah.
How
slightly.
much? Of the 15%?
So basically 3-4%.
So you're still sitting on about 12% of cash?
Yeah, you can say around 10% cash, but that is the level of cash which I would generally keep.
Healthy.
Because in a current environment where stocks have gone up, as you rightly pointed out, and if there is a possibility of geopolitical problem happening anywhere in the world, right? You don't know. And suddenly you wake up in the morning saying that markets are down 4-5%. You don't want to see a situation where you don't have cash on that day.
Yeah.
Right? So you have to have some cash, some firepower. And that's why there is some cash. But otherwise, I would say that we are not short of ideas at any point of time. Luckily, by God's grace, we are having many, many ideas. and I can share with you some.
Just where is the money if it's all invested?
So let's talk about some of the ideas.
Yeah, so pockets of value,
pockets of value,
yeah,
exactly.
I'll define that way.
By the way, standard disclosures, Parag. I mean,
yeah, sure.
You may have your...
Yeah, absolutely. Very good that you reminded. So first of all, I would like to make it clear that whatever stocks I talk about or whatever sectors I talk about, these are my personal views. Second, they might not be in my clients' portfolios. And I would say that one should take an informed decision only after consulting their financial advisors, and just don't buy because I am telling something to buy. Because we all can go wrong. We are all human beings.
Yeah, sure.
Yeah. So first, biggest disclosure that I deserve to be wrong.
Now let's talk about the pockets of value.
Yeah, the pockets of value. See, I love a situation where, so in my past, when I was an ICICI Pro and other fund managers, I have benefited from one particular fact that if a very good high quality company, means good quality promoter, good ROC, good free cash flow, debt free balance sheet, those kind of company goes through a stagnation phase of earnings. And market starts forgetting about it, or market starts giving it a lower multiple, and then there is a point, you know that this company is also doing something to address its issue, and it will bounce back. This has been my favorite playground. So right now, what I see in current market environment is TCS. It fits into that investment philosophy. Last 2 quarters were not that great. Margins this quarter was 24.1, which was below estimates. Because BSNL deal is a low margin business. They lost some business in US healthcare services, this thing. So hopefully they'll get it back. So I'm saying it for the first time, I'm saying TCS being valued like exactly as per the Infosys and HCL Tech. So PE multiples of all three IT companies have converged to 25 to 26 times on FY26 earnings. Now imagine a company which is 15 lakh crore market cap, generating 50,000 crore cash profit last year, which is going to grow at 10%, right? So in FY27, in FY26, I would say, they will end it with 62,000 crore free cash flow, right? On a 15 lakh crore market cap. And the dividend payout policy is such that 85 to 100% of the free cash flow is given to. So I'm getting 3.5 to 4% dividend yield in a TCS kind of a stock. And Fed is supporting US economy. First of all, US economy is not doing that badly.
And then
and they are saying that they want to keep it there. US GDP growth was also good last. And if you see the earnings of, for example, to start with JP Morgan, they revised their guidance upwards. Goldman Sachs, 45% growth in earnings, right? Citibank, the profit fell, but it was above their estimates, their analysts' estimates, right? BOFA. So all these clients of Indian IT services are in great shape. They are in great, although US debt to GDP might look high, but the corporates to which these Indian IT services are catering to are in very good shape.
That makes great sense because you had Bank of America, Goldman, Citi that reported numbers yesterday, and they've beaten every street expectation.
Yeah, that's what I'm saying.
If your clients are doing well, you will do well.
It's like people are waiting for TCS to call out that there is a recovery, there is a discretionary spend recovery. But you have to buy stocks when there is uncertainty. And you have to buy great stocks during uncertainty.
So TCS being one, we need at least 5 in the next 5 minutes. Being greedy.
So second, I think second space which I would like to talk about is structural space, I would say, is banking and financials, where there are pockets of opportunities. Of course, we all know SBI, ICICI Bank, great buys, and it's a consensus buys. But in small pockets also, like LIC Housing Finance, just to give you one example, when we say that India is expensive, and this is, I think, told by Mr. Manish Chokhani in one of his shows, that, see the PE multiples of banks. SBI starts at 7, HDFC Bank is at 13. So we are not expensive. The 35% of the Nifty is not that expensive. Right? SBI, if you exclude the subsidiary value, which itself is very, very highly valuable, right? They can sell stake in Yes Bank, they can sell stake in NSE. If you just deduct all that, it is one-time book value and 6 PE. Now 6 PE for a bank which is financing 25% of your economy. Right. So, and as the SBI chairman said, right, that what is good for India is good for SBI, and definitely SBI has to do well. And we are not, for example, in pockets of finance also, there is a stress in MFI, right? There is a stress in unsecured personal loans, right? SBI doesn't do all that, right? So basically, I'm saying SBI, ICICI Bank, even HDFC Bank to some extent, or LIC Housing Finance, or Federal Bank, Karnataka Bank, all these are good pockets of value in my view. Third, which I'll quickly touch upon, is cement when they report numbers. I think this will be a worst quarter.
Okay.
A worst quarter in my view, and I think many good companies will also report very bad numbers because the prices were low, demand was low because of monsoon. And now that after festive season ends, you'll see January, February, March is generally the good quarter for cement in terms of demand. And I think the profitabilities are at such levels that they'll try to increase prices. To some extent, if it gets absorbed, I think the worst will be behind after this quarter's result. So cement is definitely a space where we have not yet built in long positions, but definitely a space which we'll be looking at very closely at the time of the results.
So which cement stocks would you be eyeing very closely?
So basically, see, Ambuja, Ultratech are the larger ones, the leader ones, definitely. Then if we go below that, Shree Cement, Birla Corp kind of name comes up. Because if you see the calls of, for example, Shree Cement, they said that they'll not acquire anything. Right? They are going to just add 10 million tons every year from internal accruals. They already have 5,500 crore net cash. So I'm saying that I would like to back such companies which are not very aggressive because you are not very sure about the cycle.
And you'll allocate equally across the large ones?
No, definitely the weights will vary. For example, whatever weight I can give to say TCS or ICICI or SBI
much
of
bigger
the world.
than the smaller ones.
Yeah, then this one ones.
Any hidden gems? You've talked about large caps, right? But I think the excitement sometimes is in that broader market stock that becomes a multi-bagger. TCS can only grow that much eventually.
Yeah, absolutely. So see, and let me complete the last value of pocket of value, that is in metals. So for example, if China is able to do materially well in terms of recovery, in terms of, then stocks like NMDC, which is, so for example, NMDC, if you see today the price is 230. Next year EPS is going to be around 28, which is with a conservative EBITDA per ton estimate. And net cash company, net cash of 9,000 crores. Right? So EV/EBITDA of 6 times, or PE of 8 times. So I think you cannot go wrong there if the China recovery really happens. And I am not here counting on a big recovery. Because you are buying a net cash company. If I would have been very, very bullish, I will buy a leveraged company.
That's true.
Right? I don't want to play that in any sector. Because I am not very sure whether the cycle will really turn positive or not. Because as I have told you, every economy is constrained on the fiscal front. So I cannot expect a big fiscal stimulus from everything, which will create a big, I would say a 2008 kind of a rally when China did, bought the entire steel from the entire world. Those kind of thing cannot happen now.
So in metals, which was your top pick, you said?
NMDC. And followed by Nalco. And beyond the big players, anything that you think you're eyeing or you're spotting from maybe a smaller sector or an upcoming sector in that sense? No, so basically this is not my circle of competence. My circle of competence is tried and tested businesses. Okay. So basically, just for, we in past, in my ICICI Brew days, and, we bought huge amount of Tata Consumer Products and Bharti Airtel and NTPCs of the world. So basically one thing which I would always prefer is a Tata Group company if it is at an inflection point or if it is undervalued. This is my particular, I would say something which I love to do. In each of my portfolios, wherever I have been, whatever portfolio I have constructed, mostly I prefer that out of the top 5 holdings, at least one Tata Group company appears.
That's TCS for you.
Right now, it is TCS for me.
That's nice.
Because it is now ignored. People have given up on it, and that is what I love. When people give it up on a good company, which will also do something to reverse its losing proposition, right? For its customers, it will do something, right? You cannot say that TCS will sleep. It's a sleeping elephant. It will wake up. And when it wakes up, everybody would love to buy it. So then you buy it before that.
Got it. Well, this was the key takeaway today, I think, Parag, which is that look at pockets of value in an uncertain world. There might be merit in looking at pockets of safety companies having cash, but looking at growth aggressively at some point of time in the future. Thank you so much for joining in today, and all the best with Sensex and AIF going ahead.
Thanks.
Thank you, Parag.
Really appreciate
Great having you in the studios. You really truly were as impressive as Niraj had highlighted.
And once again, I would like to say, don't go by my recommendation of stocks. It is just out of sheer love for stocks I speak about them. And please don't make your investments based on that. Please consult your financial advisors or keep it with the institutional investors so that they can take care of them.
Right, we hope to see you soon again on the channel. In the meantime, the markets are looking okay, but like we've just highlighted, and what we want to mark is we had a very aggressive buy call coming in on Siemens from Kush as well as Chandan this morning. Quickly pull up that counter and just see what it's doing. It's pretty much at the day's high point. The volumes are phenomenal. I think 7,895 is when the buy call came out. It did make an intraday high of 8,120 or 8,222 just a few minutes ago. So looking very steady on Siemens. MCX and SP are the other two ones you want to track. But yes, we're out of time. The markets have recovered despite a subdued start. The Nifty is higher this morning. We'll take a break. We'll wrap up. But of course, Niraj on the other side on Talking Points. So stay with us.
Thanks for tuning into today's Talking Point. I'm your host, Niraj Shah. The case for a chat for our guest today. Well, with crude prices looking the way they are and commodities in general, what's the impact on India? And is there a net positive because we are a commodity importing country? I think it's an important question to find out. Is power, is there a key in that space? And is power looking strong for the longer term? Will user growth fuel quick commerce, or is it internal metrics that could help that sector as well? To talk about all of this and more, Ramesh Mantri, Chief Investment Officer at White Oak Capital Asset Management, with us in the show. Ramesh, so good talking to you. It's been a while. Thanks for taking the time out.
Yeah, good morning, Niraj. Pleasure.
No, the pleasure is entirely ours. Ramesh, how are you thinking about the current landscape? Because this opinion is divided right down the middle that we are expensive but not egregiously expensive. But at the same time, we are looking at, after 4 years of double-digit earnings growth, maybe a moderation in earnings growth as well. And could that impact the sentiment, if not flows? How do you think about it?
Yeah, we are seeing in the last 3-4 months significant slowdown in high frequency indicators. That's, and one of the biggest reason has been the lack of government spending. Government spending fell by 19% in the first half of this year. And this is very unique. In fact, our fiscal deficit is running at 20-year low in the first half. So it's basically government has money, does not spending, which is not a bad problem. It's not a difficult problem to solve. If you have money, you can always spend. So that will help the economy. So that's creating a pressure point in the short term. It's also showing up in slower corporate tax growth. While personal tax growth is actually very good, but corporate tax growth has slowed down, which is an indicator of some slowdown in earnings. Yes, market valuations are about 10 to 15% now higher than long-term averages. There are pockets of exuberance, particularly on the smaller cap side. And there's a clearly still relative value on the large cap side and in some sectors, while other sectors have a lot of expectations built into them. So it's a mixed bag. I think important part, we are not, I would say, significantly overvalued that we have to worry about sentiments and about things. So, and the good part is the two twin problems that India is seeing on the macro side. One is, of course, the lack of government spending and the fact that the rates are still high relative to inflation. Those are easily soluble problems. Imagine the opposite problem if the government didn't have money and we were running higher inflation. Then you can't solve either of the problems. But today, both the problems are soluble. And there is, of course, a certain tailwind in favors of India because of the geopolitics at work. So yes, when things are going to be good, the price is always going to be slightly more higher. You can't have fundamentals good and prices being lower. That really happens in markets.
But so Ramesh, okay, which is one part of the equation that the issues are not that big. I'm trying to think if the growth triggers are strong enough for Indian markets, whether it's the large cap indices or specific portfolios, to show very strong earnings growth as well as therefore capital appreciation. Is there a case for that, or currently it's in cricket parlance a swinging wicket and it's better to safeguard the wicket as opposed to try and make runs?
Yeah, so after 4 years of strong growth, this kind of growth in earnings is hard to replicate, right? We are getting some base effect in place now. And as I said, as economic indicators are slowed down, it will start impacting corporates. We are seeing even in consumer sector, a lot of fair amount of weakness. So yes, you're right, that one has to be, I would say, keep a balanced approach. One needs to now look at closely asset allocation, maybe start looking at keep a more balanced approach. Avoid real pockets of exuberance, which are in small caps and micro caps and all, and be more tilted towards large caps. And avoid sectors with a lot of exuberance.
Oh, okay, avoid sectors with lots of exuberance. That would mean a lot of sectors. Ramesh, I'm trying to understand this. Okay, so let me try and understand first. Is the portfolio strategy a bit of a barbell approach wherein you're probably veering towards pockets of value, but at the same time, because you guys follow this approach, right, of having an OpCo and a FinCo, and therefore your valuation models are different than what the street might usually follow. So I'm trying to understand, how is it that you're building out the portfolio currently?
So see, clearly, where we see opportunity is in BFSI, in pharma and healthcare. Our technology, we are more neutral. We are clearly seeing, and then there are pockets of very high growth in India, which is basically, I would say, a lot of tech-led businesses. Some of them have gone public in the last 3-4 years in the markets, right, where there is very strong growth. And then there are strong pockets of growth, let's say, in electronics manufacturing, on the power side, and of course, select jewelry retailers. And then there's an odd company like in apparel retailing that's growing very difficult to understand in this kind of economic environment to grow at those rates. So those pockets of growth where the growth is very high in India, those of course, valuations while are not cheap by any measures, but still tolerable. while value is clearly there on the banking side, on pharma, on IT is also, if growth comes, value is going to be there in IT also.
Okay, that's interesting. Ramesh, a bit of a here and now there. The numbers, I mean, you can argue that TCS did one, HCL Tech did quite the other in terms of commentary, really, if you will, or maybe not so much. But the ISG data that came out overnight seemed to suggest that deal-making activity is actually at multi-quarter highs as well. And I remember conversations with even managements which said that some of their clients are saying that nothing till the elections are out of the way. The elections are 1 month away. Do you sense the possibility of even multiples or earnings or both seeing a thumbs up post the US elections are out? Can it be IT's year, calendar year 25?
Well, it's difficult to say this, that it is going to be an IT year or not. But one thing is there that, of course, US elections are an event and things tend to slow down. So I think irrespective of the US elections outcome, things will start moving from there. Remember, these companies fundamentally are leveraged to global growth, particularly on the US and Europe, right? So it's going to be a function of the economic growth. I am very clear technology is here to stay and become a larger portion of our lives. So all the changes that we're seeing, on AI and all the innovation that's happening will incrementally lead to more technology spending. It's then up to incubate whether each company, how are they placed. I would still say there are a number of mid-cap and small-cap IT services companies out of India who would still grow in double-digit dollar terms in this year. And that's where clearly
I think we've just lost that feed with Ramesh Mantri. We'll try and get that going in moments from now. If I can, I'd like to pull up some charts on our giant screen to just try and make a couple of other reference points. So we're talking about IT, and what I really want to know from Ramesh is what could the smaller size product companies do? Because we know about large caps and what they will do. What is it that the smaller size product companies will do is the main thing that I do want to understand from him. Do we have Ramesh back? Okay, I think we do have Ramesh back. Ramesh, can you hear me? You can.
Yes, I can hear you.
Perfect, Ramesh. So, sorry, you were finishing your point. Please make that point and then just tie it in with this question that I had. That while everybody looks at Nifty IT and looks at large cap IT, there are pockets of growth within the IT landscape, be it product companies, be it cybersecurity firms, one or two, etc., which are all showing some pretty good growth in the recent past.
Yes, so I would say that there are a number of mid-cap and small-cap IT services companies that will grow in double-digit dollar terms this year. And if growth accelerates, then some of them will start growing 20% or more in dollar terms. And then there are product companies which are also growing in the same ballpark. So we don't have to focus entirely on the large caps. In fact, the large caps invariably are the slower growing companies in the sector now for many years.
So avoid the large caps. That's the first point, or not avoid necessarily. You can do your own research. But Ramesh Mantri is saying that there are a clutch of broader end of the spectrum companies in the IT space which could be doing well and could be looked at. I mean, viewers, please do your own due diligence. The other one, Ramesh, is before I get to manufacturing, is this whole thing around the capital marketplace, right? Because that bucket. Last 3 months, commentary was clouded around regulatory action and what it could do. Somehow the numbers from whether asset management firms, broking firms, pipe companies, exchanges as well, has not been bad at all. And now it's a very widely listed and represented sector on the capital markets. How do you think about this?
I think financialization of savings and wealth management, right, is a mega trend in India. I think it's going to be good for a long, long time in India. So while there can be regulatory hiccups in the short term, I think the big underlying trend is very strong for a long time. So we believe there's a large opportunity in this space across a variety of business models that exist, from exchanges to asset management companies to service providers in the ecosystem. And remember, regulatory action was focused only on brokers and exchanges, not so much on wealth management firms and asset management companies. So this is a very broad, I think, fast growing. I would say India is where US was in the 90s in the financialization of savings. And you have a great, at least a couple of decades, great decades ahead of you.
Wow. So Ramesh, people lose sight of the woods for the trees, right? Would you, I mean, because things like this, when they turn, a lot of times, some things when they turn, at times people misunderstand the size of the opportunity and the length of the opportunity. I'm trying to understand, would you believe as things stand, and it could change, but as things stand, would you believe that that the opportunity size for financialization of savings and capital market related entities could actually be 15, 20 years? I mean, and things and firms can be materially larger than what they are right now?
I have no doubt about this. When I go on a train, a police constable asks me advice on what SIP to do, tells me how mass we are going, right? From trying to make a fixed deposit to, asking advice on SIP, tells me that's the potential. I think it's our, in fact, failure not to harness it enough, right? But the market is there.
Sure, and which is why maybe don't get perturbed too much by temporary falls. And by the way, there is a fall. I'm not saying it's temporary or permanent, but since you're on the topic of capital marketplace, let me quickly get in my colleague Harsh to tell us what Jefferies is saying about BSE, because that is a capital market link play, and that's down 6% today, because I presume of this Jefferies note. Harsh, what is the note saying?
Well, Niraj, 6% lower today, but let that not perturb returns, because over the last 3 months, the stock has been a doubler. And Jefferies essentially suggesting that valuations have run up quite sharply. So calling out that particular point, they're suggesting that valuations have run up on the back of SEBI's new F&O framework, and therefore heightened expectations that the market has from the benefits accruing from this new and revised framework. In essence, the framework likely to hit around 25% of overall market volume. This is, of course, BSE and NSE combined. But BSE to actually benefit from this, is the market overdoing it? Jefferies certainly believes so. They believe that the valuation now implies a 40 to 50% share in weekly contracts, which is currently at 15% for the BSE. Need to wait and watch how H2 plays out, because that will hold the key. But Jefferies suggesting that 40 times price to earnings is the right way to value BSE. They've hiked their target price from 2850 to 3500. It's a downgrade from hold to an underweight, to an underperform. Now, in terms of the valuation itself, BSE at the top end currently was trading at roughly 55 times earnings. This is FY26 earnings at 86 rupees per share. This is Jefferies estimates. And Jefferies therefore believes that valuations much more stretched, maybe 40 to 50% stretched versus what they are essentially penciling in. Of course, at the higher end of the curve, in their most bullish assumptions, Jefferies believes that 4,800 would be the fair price. But otherwise, target price that they've given, 3,500 with an underperform.
Yeah, well, a bit of a fall, but let's see what happens here. Now let's shift focus. We have 10 minutes on the show. I'd love to understand from Ramesh about the India manufacturing story, because I know, Ramesh, that you've looked at opportunities, you've looked at businesses and the, not the renaissance really of manufacturing that probably started 2-3 years ago, but there are a stellar number of companies which have made their presence felt by some unique manufacturing capabilities. Do you believe this sector also is here to stay? And while there might be temporary valuation or order flow led mismatches, the longer term looks strong?
No, I clearly believe, with India's, skilled labor and technical engineering skills, we are uniquely placed in value-added, manufacturing services. We have yet to get our act right at scale on the low-cost manufacturing, except in electronics manufacturing, where India has made a lot of progress. But say spaces like garmenting, toys, a lot of low value-added, we're yet to make a play. But in the high value-added space, which is, I'm talking of complex engineered parts, aerospace parts, industrial items, already there is a lot of progress happening. Remember, unlike services company, which can rent an office and can go live in 3 months, hire people will go live. Here you need to acquire land, get approvals, set up a plant, which takes 2 years, stabilize plant, and then scale up. So, any process takes a few years of scale up to happen. So it's usually a 3 to 4 year cycle before things start scaling up. But there is a lot of interest in India, more manufacturing to India. If you've been following stories, Germany has been rapidly losing competitiveness in manufacturing. A lot of plants shutting down in Germany across industries. And clearly there is a shift in manufacturing happening. I think on the value-added side, I'm very bullish about manufacturing in India. Apart from electronics, on the low value-added side, we have not seen a lot of success as yet.
Okay, so Ramesh, could you elaborate that point when you say value added, and you classified or clarified it by saying that there is some small value add happening in electronics, if I got that right, but you are saying that that's not all. There are other things to play in manufacturing on the value added side. Could you just give us some sense of what you're trying to say?
Yeah, so what I'm trying to say is, whenever India has to make, auto components, pharma chemicals, you get into industrial items, whether it is in aerospace, defense, industrial parts, we are making a lot of progress across companies. And these are typically engineered items which require a lot of technical skills, and also, complex machining, right? Which is where India is making a lot of progress as we speak. On the low value added, which is basically assembly and labor intensive manufacturing, we have already seen a huge success in electronics manufacturing. The rapid scale up India has done in mobile manufacturing, TV manufacturing, and now it's moving to IT hardware. A few companies have done extraordinarily well even in public markets. But this story of manufacturing hasn't moved to other parts of the low value, labor intensive manufacturing, for example, garmenting and all, where we have not scaled up as yet.
Interesting. Ramesh, the other interesting thing was I've heard from so many people about some very niche manufacturing prowess in the country. The companies making unique products for even a Tesla or global aerospace companies, and that whole belt of manufacturing that has come up. It's quite stunning to see there. Valuations you don't think have run amok. You believe that there are pockets of value here.
No, so see, India is a growth market on manufacturing, so valuations are not cheap. I think some of these companies will scale up. I have seen companies which have added 5x capacity in one shot. Just imagine adding 5x manufacturing capacity in one shot. That tells you the market. So many of these companies today are constrained by manufacturing capacity rather than demand. So when you have that situation, you are okay to pay more higher valuations than situation where companies have to fight for demand.
Got it. Okay. I have two more things to understand from Ramesh. The last question I'm going to keep on consumer tech, food delivery and the likes. But before that, since we are talking of manufacturing, Ramesh, just drawing your attention here, and viewers, you can see this as well. This is the power play of India as per CEA and CRISIL and a consulting firm about what is the kind of capacity, installed capacity as of March 2024. Coal accounted for a lion's share. There's some bit of there in renewables as well, and large hydro. And look at what the belief is. Expected installed capacity by fiscal 2030. Coal share hardly moves up. What really drives up higher is renewable in a meaningful way, some bit of large hydro as well. Remember, nuclear doesn't become a large powerhouse until many years. Ramesh, how does one play this, if at all? Is this already discounted? Are there ways to play this whole push towards renewables that India has embarked upon?
First, I think energy is structural to growth. So any country cannot grow without per capita income, without significantly increasing per capita energy consumption, and the most efficient form of that is power. So power demand is growing, and India is particularly facing an acute shortage of peak demand power. And remember, renewables, because of their variability, cannot solve the peak demand power, particularly in the evenings in India when the sun is not there, and wind tends to be very variable. So you need alternate solutions. in the interim, we are still resorting to thermal because thermal, and nuclear capacity. But I believe the structural solutions, and there is also an attempt to build pump hydro. But remember, hydro are long gestation projects. So we'll continue to remain deficit in the evening market for some time. I think the solution will happen in batteries, grid scale batteries. Even in the last 3 months, we are surprised at the pace at which grid battery prices have fallen. And I think in 3 to 5 years, solar plus battery would start competing with thermal. So that is going to be really the long-term sustainable solution to power India. Now, the way to participate is many ways. I believe one simple way is to invest through power financials. Other, of course, is within there are, of course, a lot of capex is going to happen by utilities and a lot of growth is going to happen by utilities. But remember, this is going to be very capital intensive. So utilities have to keep raising money, both equity and debt, to grow. So I would actually play this space more through equipment companies where there is significant shortage. So whether it's transformers, conductors, cables, and then there is substations. So and of course, specialist EPC companies in this space. So within that whole power ecosystem, we'd like to play more through equipment companies and also through power financials and less through utilities themselves.
Less through utilities. I think that's a telling point too. So keep that in mind. By the way, speaking of that, just wondering if transformers and rectifiers completely off. I'm not saying Ramesh recommended it, but just look at that stock. Again, 3.5% higher. You heard the management a few days back and the growth prospects that they're talking about. Very interesting mover there. Ramesh, my final question is on consumer tech. And the whole conversation of what's happening in... a flurry of notes around food delivery, for example, right? I just wanted to understand from you, when I go through notes on Zomato, for example, I'm not asking you to comment on Zomato, but when I go through notes on Zomato, most of them suggest that growth is coming in from GOV growth, while the AOV growth is kind of muted. So is it to say that growth, and that's the expectation. So is it to say that growth will come in from higher user base, or will the wallet share also expand? Because I would like to believe this is still a nascent industry. So why is AOV growth showing muted trends?
No, so if you have growth, average order values may not go so much in India, but actually revenue growth requires more. You see, growth happens because of 3 reasons. One is simple average order value going up, more users and more usage. So clearly in India, the potential for the markets to grow has to be on the more users and more usage. And the exciting story about, the likes of these food delivery platforms is not so much now on food delivery, which should probably grow at 15 to 20% long term. I think the hyper growth is going to come on the quick commerce side, and where their business model is completely disruptive to the Kirana format, to the large retailers, or modern retailers, and also to the likes of Flipkart and Amazon. So this is really the game-changing story in these companies. And this quick commerce is a uniquely Indian business model. It probably will get extended to some emerging market. It doesn't work in the Western world. But this is a very unique solution to the design of Indian markets and the Indian consumer, the needs of the Indian consumer.
Wow. Okay. And in some sense, I love the business model because it also solves the issue of employment, right? People can argue all that they want about gig workers and their rights, etc. And all of that is important. But the point being that there is a large labor force getting employment, which I somehow love, Ramesh. I don't know how you think about it, but I really love it. The fact that there is employment.
I think people miss this point that actually it's creating a lot of jobs because this is a labor intensive operation. So actually, on a net basis, these companies actually end up creating more jobs than the other retail formats.
Yeah.
This is a very important point you talked about.
Yep. Okay. Ramesh, fascinating talking to you as always. Great data points. Thank you so much for speaking to us and to you and yours. Festive greetings. Hopefully we talk in and around the Diwali time.
Yeah, best wishes to everyone. Thank you.
Thank you so much. And viewers, that's it on this edition of Talking Point. Thanks so much for tuning in.
Markets trade flat with a positive bias. Nifty comfortably trades about 25,000. Hindalco, HDFC Life, SBI Life lead the pack. M&M, Nestle are the top losers in trade. On the sectoral front, media, real estate, healthcare drag the markets. Meanwhile, banks and financials remain steady in green. And Adani Green Energy has decided to defer its $1.2 billion 20-year note in the US bond market. The deal will now be executed after the US elections and is expected to be lapped up by investors on account of its attractive credit rating. And BSE declined sharply on Jefferies' downgrade with an underperformed rating with a target of Rs 3,500, which is a 27% downside from current levels. And all eyes on Bajaj Auto. The company is expected to report its earnings today. Revenue expected to rise 22% and margins may see slight expansion. Volume growth will be a key factor to watch. Hello and welcome. This is Samina Nalwala, and Agam and me over the next half an hour will take you through all the F&O action in the markets. It's an interesting morning. We started off flat. In fact, implied Nifty was indicating to a 100-point downtick at some stage, but we've opened slightly lower and actually bounced back into positive territory. So despite the fact that there were concerns about follow-up buying, it seems like the markets are holding themselves together in early hours of trade this morning. The breadth of the market is okay. The bias remains on the upside. Sectors that are moving, Bank Nifty for the third straight day is trading higher, closer to levels of 52,000 as we see it. So all in all, it's not a bad-looking market as we see it. I come 51,921 on Bank Nifty, and I think that's a little bit of a relief. It's not sold off, and I'm taking heart from that, despite a two-day move. The Nifty itself, implied was indicating to a weak start. Asian markets were low, but we are holding on to 25,000, and I think that could be a little comforting. Do you agree?
Yes, I absolutely do. The holding on to 25,000 is of some prime importance because not only is that psychological round number, but we also have a lot of, in terms of positions being built around 25,000 with respect to sold puts. Now, sure, we are looking at 25,000 being held, but it's also perhaps on expected lines because you do remember that about a few days ago, and since then, we've largely seen the Nifty move sideways. We haven't really seen too much traction otherwise. And it also seems like we're in that phase where we're just going to take a little bit of a breather while we see a lot of stock-specific action beyond just indices. And that's very evident in the kind of change that you're seeing in open interest for, the Nifty. The Bank Nifty, again, the picture isn't very different. At least in the past, we haven't seen too much traction in addition towards open interest. And this time around as well, the index remains flat, and there is a little change in open interest there either. When it comes to the options market, for the Nifty specifically, as I mentioned, we do have a lot of writing around the 25,000 put, and on the higher end, the range has come off and narrowed by quite a bit because we're also starting to see more and more writing around the 25,200 mark. So it's what the street is factoring in at the moment is a roughly 200-point range, and that's based on the bets being placed in the options market right now. But moving on, when it comes to the Bank Nifty as well, it's the weekly options expiry. We're watching out for the Bank Nifty, again, holding on to 52,000. The kind of strikes that we're playing with when it comes to the Bank Nifty specifically, sure enough, you do have a range between 52,000 on the higher end and 51,500 on the lower end, but this becomes narrower between 51,800 and 52,000 specifically in today's day of trade. Do remember that the first 1 hour trade has seen nothing at all in terms of direction, and that has actually led to a significant contraction in your weekly options expiries already as far as today is concerned. So a lot of these strikes have seen a significant deterioration in your option premiums just in the first 1 hour of trade. It becomes very, very risky if you are short options, and it could potentially mean a little bit of an opportunity if you're long options, but again, it will require a sharp move, something that the market is factoring against. That is the lower probability of a sharper move on the index. But all in all, consolidation continues, Samina, and the key benchmarks hold on to key levels?
There are a few small sort of sectors that are looking really good this morning. So AMCs and insurance companies are up and about in trade. You've also got smaller EPC companies and, of course, counters like a Railtel that are gaining on order wins from the Maharashtra state government. So Railtel, GNT Infra, PNC Infratech, a few of the counters that are turning out, GR Infra, pardon me, PNC Infratech are some of the counters that are raging in early trade. Stocks like Cochin Shipyard are seeing pressures. The government looks to divest their stake. And on the Nifty 50, it's counters like HCL Tech that continue to hold steady after reporting numbers yesterday. But Ajit Mishra and Amardeep Singh both join in with their top trading ideas. Ajit, I'll start with you first. We're respecting 25,000, even though it seemed a little fleeting at opening this morning. How do you feel about the index? Do you feel like a long trade in this range of 25,000 to 25,200 is worth initiating?
Yeah, good morning, Samina. So, yes, it seems like that, yesterday also we saw a similar kind of a trend where 25,000 we were closely holding, and today also we made an attempt of recovery. But at the same time, Samina, we are seeing a diverse trend within Nifty and the banking index, because if you see the heavyweights like Reliance, TCS, they are still reeling under pressure. Today there was an attempt of recovery in Reliance, but again we are seeing profit taking coming in. So this is a kind of like scenario where one should wait and watch, because in case if we break 25,000, there is a possibility that we might inch toward 24,700, the previous swing low. But at the same time, since we have this weekly expiry of banking index, HDFC is holding strong. So there could be an attempt of a breakout about 20 EMA in banking index, which might result in some respite in the index also, Nifty also, which may help the index to inch toward, let's say, 25,100, 150 zone. Around that area, one can look to go short in. So at present, I feel it's prudent to avoid any fresh trade in index until we see a break from 25,000, 25,200 range. And the focus should be more on banking. So once we break 52,000 levels, then there's a possibility that we might see a further upleg towards 52,500, 600 levels in the banking index. Around 50, on a break of 52,000 mark, decisive break, one can look to go long through call option in banking index.
So one can look to go long on the banking index. Of course, that one remains in the focus on account of the weekly options expiry. But let's get Amar into the conversation too. Amar, good morning. Thanks for joining in. What is your view on the benchmarks and how are you approaching them?
Yeah, I would say if I look at the benchmarks currently, they are clearly indicating that higher levels are being sold into. And also, if you look at the put call ratio, for the Nifty, which is expiring tomorrow or the next week, or for the monthly series, we are seeing that more of calls being clearly written. So that shows that there is definitely selling pressure in the market, and also some of the heavyweights are clearly pointing towards that higher levels will be sold into. Technically speaking, some of the short-term indicators are extremely negative. So that effectively means is that any level towards 25,150, 25,200, 250, higher on the upside, that's going to be sold into, and we could witness some sort of selling pressure along those levels. On the downside, yes, 24,800, 24,700, that's a very strong support zone. But from a short-term perspective, yes, definitely the bears have an upper hand. And looking at Bank Nifty is slightly positive compared to Nifty. There's no doubt about it. But Bank Nifty also needs to sustain above the 52,000, 52,200 mark for any upside rally, because higher levels again will be sold into Bank Nifty towards 52,300 to 53,500, because here also the some of the short-term indicators are extremely negative. So that means that higher levels will be sold into, but if one prefers to buying Bank Nifty is a better option as compared to Nifty right now.
Going long on Bank Nifty instead of the Nifty is a good option. That's what Amar recommends. Ajit, let's talk stocks now. You've got a couple of... actually, you've got one long trade and one sell trade. I know cement is supposed to have it very rough and probably one of its worst quarters with regard to earnings. So you've got a sell call on that and a buy call on NTPC. You want to take our viewers through it, Ajit?
So why NTPC? Because since we are still seeing that markets hovering in the range and we are seeing select pockets doing well, NTPC after this recent consolidation in a very tight range seems upbeat for a recovery, or it might inch toward the record high as well. So the risk reward is favorable. One can go long at the current levels with 422 being the stop and 442 as the immediate target. At the same time, we have like a fresh breakdown in Ambuja Cement today with the very strong volume. So indications are in the favor that there could be next down leg for Ambuja. So which close to around 562 is something that the stock might test. So with stop at 587, one can go short in Ambuja at current levels.
Right. Let's also take a look at Amar's stocks which are on his radar. Amar, what are you betting on today?
I would say the first stock is Axis Bank from the banking space, because the stock has corrected from almost 1300 levels. Currently, it's around 1150. And what we are seeing is that the stock is finding very strong support around the level. So there is a high possibility of a pullback from the current level. So Axis Bank, one can look at a bull call spread for the October series, buying the 1160 call option and selling the 1180 call option. So this is one trade one can definitely look at with a stop loss of 1 and a target of 26 on the upside. And the second stock to look at is Godrej Consumer Products. So this again, if I look at Godrej Consumer Products, what has happened is that the stock was trading around 1540 levels, and then it formed a double top there. And from there, the stock corrected almost to 1300 levels today. And for the last 2 days, we've seen some positive momentum. And again, the stock is inching higher, and the stock is strong on the long-term charts. Intermediate term trend, I would say it's more or less evened out. But from a short-term perspective, it's moving from oversold territory. So this is one stock one can definitely keep a close watch on for the October series, October futures series, and buying at any correction with a stop loss below 13 and a target of 14.15 on the upside. So this is the second stock one can keep a close watch on.
All right. Well, while we're at it, and before we go on to taking up some stocks, want to very quickly take a look at all the stocks which are buzzing in trade and seeing an increase or a decrease in open interest to see where there is in fact a lot of traction. So right at the top, we've had some positive calls coming in on HDFC MC in terms of brokerage notes this morning, and CLSE specifically, of course. We're looking at a 5% up move there. We're looking at longs about 6.5% added there. Dr. Lal PathLabs, on the other hand, is looking at shorts. ABB and Siemens are the other two very interesting stocks which are actually looking at advances in today's day of trade. Voltas, along with Deepak Nitrite as well, looking at an up move. Voltas is once again stands out here, where we've seen a sharp 4% up move here. And Deepak Nitrite, again, is where we've seen, analysts give positive calls as far as, this particular one goes. What about stocks which are seeing unwinding? Let's pull that list up as well and see how things are faring. We have a long unwinding cover Glenmark, Ipca, as well as L&T Financial Services, which will in fact announce its earnings today, by the way. And of course, Cummins and PI Industries are looking at about a short covering. With that, let's pull up one of these companies, and maybe I'll take up Siemens with Ajit. Ajit, your view on how things are looking, because it does seem like Siemens is at the cusp of breaking out. Is that a possibility under those circumstances? How would you trade this one?
Yes, Agam. So in fact, if you see, that's almost like 3 months of consolidation that we have ended. The stock has reclaimed the record highs, though we are seeing some profit taking in the higher end, which is natural. So once we make a new high, there's a possibility that the stock might spend some time around the current area. So it's a possible base formation that we might see in the stock. Fresh buying, one should do in a gradual manner. One should not go all in. So in the range of, let's say, 7,800 to 8,000, one can accumulate the stock with a closing stop at 7,600. And the next leg, probably we can inch toward 8,450 to 8,500 levels.
Ajit, the follow-up actually from Siemens, another counter that's been flying recently has been MCX. How does this one look on the charts?
So, Samina, it's a very gradual up move. The stock is trading at the record highs. There's hardly any correction even during the recent downturn in the market. So that clearly shows outperformance. But now we are slightly more against the averages. So there's a possibility that we might see some consolidation or some profit taking also. So if you have an existing position, I would recommend at least booking some partial profit and maintaining a trading stop at 6,200. for the existing trade, because there's a possibility that we may see some correction first before we inch further northward.
All right. Well, with that, let's move on and talk about a handful of other factors, and perhaps we can start taking up queries. And the first one is from on Tata Power, in fact. I will take this one up with Amar. Well, we have Manisha from Surat, and she holds the Tata Power 480 call. She's paid a premium of 9.1. The question is, should I hold or sell? Let's pull up Tata Power. Let's see where things are faring and how things are faring there. So the 480 call at the moment is a tad away from being at the money, because the spot is at around 460 odd. So about 20 rupees more, nearly 5% before we see Tata Power become in the money. It also seems like there's a deterioration in the premium paid. So from 9, it's become 5 at the moment. But again, Tata Power is a stock where if you do see a sharp move, you never know. Things could, in fact, will change for this specific call option. But let's take this up with the expert. Amar, what is your view on Tata Power, and what would you do with this 480 call specifically, for which Manisha has paid a premium of 9.1?
Yeah, I would say if I look at Tata Power, clearly it's, from a short-term perspective, it is in for consolidation after the sharp rally towards the 495 levels. The stock had made on 27th of September. The stock corrected, and currently it's witnessing some sort of consolidation. So if one were to look at the chart from a very short-term perspective, there are only 2 levels to keep a close watch on: 455 on the downside and 470 on the upside. So till the time we don't see a breach above the 470 level, I would say it could be in for consolidation. 455 has a good support. So it's more of from a trading perspective. There is right now the short-term trend is definitely flat. So unless we see some fresh trigger in terms of the price breaching the 470 level, it could be in for consolidation, and the premium for the call option could further decline. So either she can look at the level which I've talked about. If that is B, then she can hold on to his position. Otherwise, getting out of the position would be a better idea.
Okay, well, there you have it. Let's move on and talk about Nestle then, and yet another FMCG company on our radar. I will take this one up with Ajit. Well, Vedic from Bangalore says that he holds a Nestle India 2460 call, and he's paid a premium of 33. What should he do? In fact, Vedic is looking to add to this specific call option. Ajit, do you think that's a good idea? Because while he's paid a premium of 33, it's currently trading at 42. Do you think that would be a good idea to add?
So certainly not, Agam, because please do not add to your loss-making position, especially if you are option buyers, because you might end up losing more. Because if the stock has declined, and especially if you talk about Nestle, unlike the other FMCG counters, it's almost a vertical fall in Nestle, and it's not respecting any of these recent supports, be it the long-term averages. And now we are almost on the verge of breaking the previous consolidation range low also. So all these indicators are in the pointing towards maybe further decline. Or there could be marginal uptick here and there, but I doubt that can meaningfully add to this existing calls. So do not add to your loss-making position, and at the same time maintain today's low as your stop loss, which is around 24.35 spot area. And if we see any intraday bounce also, then we should look to exit. Overall trend looks negative to us.
Ajit, I just want to follow up on that one, because it's actually not a loss-making one, because the premium paid was 33. And of course, it's currently trading at 48. Still, I've assumed that you wouldn't recommend adding to the position, but would you hold on to this?
So not if it's a call and he's still making money, then definitely he should book.
Okay. All right. Point taken. All right. Thank you. So that's the view on Nestle. I hope that satisfies the query question here. And on that note, if we do have time to take just one more query, we will take one up on Coal India. And I will take this one up with Amar. We have TKS Nair from Mysore holding Coal India 515 call. It seems like everyone's trading options. No one's trading futures. But yes, the Coal India 515 call, and he's paid a premium of 3.1. It's nearly around there, and the 515 call is a tad further out at the moment, considering the underlying is below the mark of 500. Amar, what was your recommendation on Coal India and specifically the 515 call, which is at price for the viewer?
Yeah, so if you look at Coal India, what we are seeing again is some sort of consolidation post the sharp move which the stock had witnessed. So from 26th of August, the stock has corrected and it's in for consolidation. So Coal India, but overall, it's very strong on the long term, on the intermediate term trend. So I would say that he can hold on to it, but time is definitely of essence for an option buyer. So there's one level, 502 on the upside, 502, 503 on the upside. Currently it's around 496. So the moment the stock starts trading above 502 levels, then one can witness a sharp move towards 510, 515 levels. On the downside, the stock is very strongly supported on the 490. So that's a level he should keep a close watch on. He can hold on to his position. Any trigger above 502 could be an opportunity for exiting in profit.
Stock that we have is Wipro. Now remember, this has been rather resilient in the last couple of weeks, and more importantly, you've got their board meeting on a bonus issue tomorrow, and you've also got earnings reporting coming in. And I guess in that context, our next query is from Rekha from Hyderabad. She is holding Wipro October 540 calls at 21.3. Let's quickly take a look at how those calls are doing. Wipro is holding flat on a day when IT is seeing some weakness, but again, it's out of the money quite significantly. Ajit, you want to have a go at this one? It's ahead of earnings, ahead of bonus issues, so it's an event-based move that we could anticipate tomorrow. Rekha is seeing some losses. What do you recommend she does? Takes the losses, cuts a position, or continues to run it for the next few days?
So Samina, within the IT major basket, I would rather suggest her to stick with the top names which are trading at the record highs like HCL Tech and Infosys. TCS was also comparatively better post numbers. We are seeing some correction. So Wipro is last in that list, and we are still not seeing any sign of decisiveness at the higher end. So whenever we see the stock inching toward 555, 560 zone, there's some selling pressure emerges. So I would suggest, though the results are impending, but one not to wait for the results. Enter the stock only once we break this 555 barrier and upside maintain a target for 580, 85. But preferred counters are definitely the heavyweights like HCL Tech and Infosys.
Okay. All right. Well, there you have it. That's the view on Wipro coming in. And on that note, thanking both our experts for joining us and taking us through their views on the markets, giving us a handful of trading ideas, and of course, solving a whole host of our viewer queries. Well, with that, we shift focus to the commodity space, and we have Ajay Kedia, director at Kedia Advisory, who joins us on the show. Good morning, Ajay, and thanks for taking the time out. What's the first commodity on your radar? I reckon we can start by talking about gold. How are you looking at trade panning out for this one?
Very good, madam. See, as we have entered in October, all were expecting gold prices should go up because already we have seen Fed in the month of September cut down rate by 0.5, and expectation was very high for November rate cut also. But slowly and steadily now, expectations are very high for 0.25 rate cut in the month of November, which is not at all supportive for gold. But on the other side, geopolitical tension in Middle East is continue to support gold prices. That is why in last 15 days we have seen prices moving in a very broader range of, let's say, 25.90 to 26.50 for gold in international, whereas domestically we see prices moving in a range of 76,600 to 75,500 broadly. So I think the market will keep on trading in this range only. No doubt tomorrow we will be having a key data from US retail sales or unemployment data, which will give some clear idea. But as of now, I think prefer to remain at a choppy range of 76,600. One can take short with a stop loss of 76,800. Limited downside with 76,100. Similar kind of movement has been seen in silver also. Very great rally in the month of September, but now market is consolidating in the range. 92,200 would be great level to take short with a stop loss of 92,800, targeting 91,000 as of now. So, in very short period, we may see some correction, but medium term to long term bullion seems to be very strong.
Ajay, that of course is silver. What I do want to talk to you very quickly about is also how crude has been performing, right? 4.6% lower in overnight trades, stabilizing this morning is what we notice. But there's so much of geopolitical uncertainty. There's also the fact that OPEC has, reviewed their demand outlook going ahead. Keeping those two factors in mind, how do you approach crude? Do you have a long trade on it, I believe? Are you using this weakness to initiate long trades?
Yeah, I think in last 2-3 sessions, we have already seen prices has reacted. First of all, the story with the Israel and Iran conflict, because there was a threat that maybe Israel can target oil refineries or oil facility, and that was the trigger. Because of that, on Friday we have seen a very good rally. But now things have been settling down in Middle East. No fresh threat has been there for Iran nuclear and oil facility. That is why some correction has been there. Secondly, the outlook. We have seen OPEC and IEA, even China. All these factors are slightly creating pressure because demand concerns are still prevailing. We have seen China coming up with a stimulus, rate cut, everything, but no clear direction has been there from China. That is why we have seen correction in base metal also and crude also. But I think technically prices is making a base WTI at $70, Brent around $76, and this could be a technical bounce only. That is why October month can be bought at 29.20 with a stop loss of 28.20, targeting at least 6,050 to 6,100 in next couple of days.
Thank you, Ajay. Those are all a bunch of calls. Sadly, we're out of time, but you've got a sell on gold and silver, a buy on crude, and a buy on base metals as well. So buy on copper, zinc, and aluminium coming in from Ajay. In the meantime, the markets are trading flat, lacking direction or momentum at this stage. But with that, we're completely out of time, and there's a lot more programming on the other side, so keep it with us.